Good evening, all. An unusual late night space by popular demand. Tom Thornton made me do it. I got a lot of inbound traffic today. We've done two spaces last couple of days. Wasn't going to do one, but by popular demand, here we are. So, what a day. Can't say it's a great surprise. Maybe it's a great surprise to Brian Belsky on CNBC today. The surprise for me was actually yesterday, though I have to say I'm not surprised by anything anymore. The market has no institutional memory from one day to the next. I sat there yesterday after the Fed did its thing. I had no idea what the market response function was going to be. Nobody knows. I'm trying to predict the market on a daily basis is a fool's errand. I think Mike, and we have got a great room here today. So we got Tom Thornton, Tony Greer, Michael Belkin, and someone took a shot at Belkin the other day. They said, "Oh, each time you've come on, Michael, in the last couple of months, the market goes up in your face." I think you even said something about that. But for people who want picks and try to figure out the market on a day-to-day basis, this is just not the room for them. We're just trying to get the big picture right, the trend right, and boy, have we gotten it right. And I'm very proud of what we've done here. So many smart people make this room great, and the room makes the audience makes the room great. But Tony Greer, Michael Belkin, Tom Thornton. Hopefully, we'll get John Roken here a little bit later. Guy Cirandulo, Chris Ferrone. I mean, Michael Howell. It just goes on. There isn't a single concentration of brain power that's been as powerful and as accurate as this collection. And I salute all of you, and I thank you. So where to begin? Again, to me, day to day, I have no idea what the market's going to do. Nobody does. I was busy making a presentation yesterday afternoon, which ended just around 2:00, and the news came out of the FOMC, and everything goes up and to the right. And I looked at it, and I was like, wait a second. Jerome Powell seems unable to find his inner Paul Volcker, and unless he's able to, I think that the song remains the same. Inflation is high and doesn't show any signs of coming down. In fact, I think there's a good chance it's going to go higher. We're still running a wildly stimulative monetary policy, and actions have to be taken. And the Fed has told you that they want to tighten financial conditions. Specifically, that means get the stock market down. So instead of having a Fed put, we now have a Fed call. And I sat there and watched the market take off yesterday afternoon. I was like, this is nuts. So I had no idea it was going to, soar yesterday afternoon. Didn't expect it was going to crash today. But I guess we're kind of where I thought the market should be, given everything that happened. And the bond market's calling BS on what the Fed is up to. And for those of you who are old enough to remember, and I know Michael Belkin will, and actually I'd like want Michael and Tony to kick it off. But we used to have the bond market vigilantes back in the day, and they've been rather quiescent, if not extinct, for the last few decades, but now they're back. And the really cool thing or interesting thing about now, let's look at the screen right now, the 10 years at 307 as I speak, used to have a negative correlation between stocks and bonds, and now I've got a positive correlation. So the relief valve that you would have, the market tanks in years past, bonds would go up, yields would go down. That's why the 60-40 portfolio would work. Well, now the 60-40 portfolio is dead. Long live the 60-40 portfolio. So the reality of it is, and we've talked about this a lot in these rooms, and Michael Belkin, I'm going to turn to you first, even though you were just in here a couple of days ago. The Fed pumped in all this funny money, the most reckless, irresponsible monetary policy in the history of the world, combined with massive fiscal stimulus, which caused this whole bubble to blow up. And now we're normalizing. And they can try to control it, but one way or another, the market's going to find its way. At any rate, I don't want to ramble on too much. I have a lot to say, but there are a lot of smart people in this room, and I want to hear what they have to say. So we're going to start with Michael Belkin. Michael, welcome to the stage. Say, it's all yours. And then after Michael's done, we'll go to Tony Greer. And I'm hoping Tom Thornton will chip in.
Hey,
Hey,
George,
yeah,
Tommy. Yeah, hey, sorry, George. Tommy, it's not working. Can you go out of the program and come back in? Because it's not working. Please, thank you.
No, he's in. He's in now. He's in. Hey, Tom, you
No,
there?
he's in, but I can't get him up to speak. There's some problem there.
Hold on. Tom Thornton, can you speak? Unmute yourself,
Yeah,
Tommy.
hey,
Oh,
I'm
there
here.
he goes. Now he's here.
Okay, fine. All right.
Cool.
Stay up there, Tommy. Okay, cool. All right. So, Michael Belkin, good to see you again. We got to stop meeting like this. It was only 2-3 days ago, but we're back. So we'll go Michael Belkin, Tony Greer, and then Tom Thornton. Michael, the floor is yours. Welcome, Michael.
Okay, can you hear me? How's that, John? How's that, George? Can you hear me?
We're perfect. I don't know what you did, but you're a real tech genius tonight. Go for it, Michael.
Okay, great. Okay, so a couple of days ago, I talked about rising volatility, bigger percentage swings in the market. And if you, going back to that idea, if you think of a graph of daily percentage changes for the S&P 500, generally in a bull market, it's kind of narrow, up 0.5%, down 0.5%. Market inches up on low volatility. And when the market goes into a bear market, the volatility bands expand. So it looks like a megaphone pattern. So it goes, you get bigger moves up and bigger moves down. The market ends up lower, but you get these rallies like we had yesterday. So I alluded to that, of course, it's always fun, like it's hilarious that I give a bearish presentation and the market goes up 5%. But anyways, let me just flesh out the idea about volatility for a second. We were up 5% in the NASDAQ yesterday, down 5% today. We're at the bottom of the range where the market has been in price terms for all the indexes, Russell 2000, S&P, NASDAQ, Dow. And any move down from here is probably going to be like a waterfall decline. And that's what I'm expecting. One way to quantify this is the 20-day standard deviation. So the 20-day standard deviation annualized for the NASDAQ is 39% right now. That's huge. So the way that you interpret that is there's a 95% probability that the market's going to be up or down 39% in the next year. That's basically the back of the envelope meaning of that. That's huge. So generally, volatility is below 20%. So we're headed into a period of big market swings. Don't be surprised if you get big up days followed by big down days. And as I mentioned last time, it's like up 3, up 4, down 7, down 6, up 3, up 2, down 10. So that's the pattern. In a bear market, it's very simple. You sell the rallies. So you don't sit there thinking it's the bottom, because it's not yet, as far as I'm concerned. You wait until the market has this crazy, Mr. Toad's Wild Ride, from Disneyland days, where you go careening into the wall. Now, the VIX, that's realized volatility. The VIX is option volatility. It's 31 now. It peaked at 66 back at the March 2020 coronavirus lows. I mean, when the market was at its lows, volatility peaked. So where could the VIX go? It could double, I mean, and I don't have a firm number on it, but yeah, volatility is a little bit high right now, but the option volatilities could really go through the ceiling. And let me say where the market could go. By the way, one other thing before I do that. Yesterday, with the NASDAQ up 5%, there were 22 new highs and 653 new lows. And that was, if you needed something to laugh about, that was it.
Wait, Michael, is that a typo? 22 new highs and 653 lows? Are you serious?
That's right. Yesterday. So, and the other thing I want to mention is TRIN, TRIN. Now, TRIN is a formula that measures it's advancing issues divided by declining issues, and then that's the numerator, and the denominator is advancing volume divided by declining volume. And what it basically tells you is how much volume is going into a small number of issues. So yesterday, the 3-day average trend, TRIN, for the New York Stock Exchange was 0.61, which is off the charts down. It's the lowest all year. It's the lowest since January 27th, 2021. And what it does, you only get readings like that when people are like foamingly bullish. So somebody's like, buy, whoever it is, don't ask me who, they, in quotes, if it's central banks or the plunge protection team or just, regular old investors or the hedge fund mafia or who knows, I don't know, or, algorithms or dealers hedging, their volatility positions, or all of the above. Anyways, that's just unsustainable. So to me, that was just the biggest, basically insanely overbought reading in trend in the middle of a bear market. Like, how does that happen? I don't know. It's crazy, but that's unsustainable. So anyways, where could the market go? Let me give you some numbers. So the 200-week average is a really good target for that's where things revert to. If markets are a mean reverting process, which I believe they are, and I just use trend analysis. It's not really technical analysis. It's just things revert to their mean. And I see this over and over in all kinds of things that I follow, including ratios of sectors to indexes. It's almost magical the way it's just like a regression line that things would go back to. So anyways, that's where indexes could go sort of quickly. And that number for the NASDAQ is down 17%. So right now we're 12,850 on the NASDAQ 100. The 200-week average is 10,655. On the S&P, it's down 16%. So we're currently at 4146. The 200-week average is 3468. So it could go down 16%. Some of these other stocks. Now I don't have all day here, so I won't I won't hog the podium. But let me just say there's huge downside risk in the big cap tech stocks. For instance, Tesla. God bless him, Musk. I'm glad he's buying Twitter. Maybe it'll turn back into a free speech platform. But the stock price of Tesla is probably the most single thing that stands out in the market now like a sore thumb. 200-week average down 56%. Okay, that would just be a correction. I mean, we're not talking, a bear market correction. But so for the NASDAQ, it's down 17%. For Tesla, it's down 56%. Apple, down 38%, 200-week average. Microsoft, down 29%. NVIDIA, down 37%. AMD, down 24%. So even though these large cap tech stocks have rolled over and they're getting headlines now for being, not a good place to invest, they have a lot more downside. And let me just say, even in the midst of all this volatility, the market's unchanged on the week. I looked at this before this call started. We're basically unchanged on the week. So nothing's happened yet in terms of what could happen. So we'll see what happens, Thursday and Friday. But this thing's kind of, it's looking for an excuse to go down. My model forecast, everything I do is based on the model. Long-term forecast is down. And by the way, ultimately, the 200-week average is sort of a kind of short-term, intermediate-term target, down 20-ish% for things. The 200-month average, that's where really long-term bear markets end. And the last time that S&P got there was 2009. So you get there at the bottom of extreme bear markets. So after the 2007 peak, the S&P declined by more than 50%, it bottomed right around its 200-month average. Not precisely, but right down there, actually below it. So let me just tell you where that number is. So that would be more of a long-term, sort of a 1 year view, 1 to 2 year view, where things go. NASDAQ, 200-month average. NASDAQ 100, we're now at 12,850. 200-month average is 48.25. That's down 62%. S&P, we're at 41.46. The 200-month average is 2,041. So that's down 51%. So basically, the market over the course of this bear market, not tomorrow morning or anything, but we're headed lower. We're in my work, we've started a long-term bear market back, October. The NASDAQ peaked in November, and early January was when the other indexes peaked. But a lot of stocks have been going down. And today, software stocks were wiped out. Shopify down 15% with the NASDAQ down 5%. A bunch of other software stocks, CRWD, ZS, Snow, HUBS. These are all stocks in the report from my sell list and short list. These were all down more than 10%. But so bottom line, we're in we're in a period of increasing volatility. We're already having these 5% swings. Don't be surprised if if you get 7% down, followed by 3% up, then 10% down, followed by 5% up, but the market ends up lower after all that. It makes it very difficult, unless you're a super ace short-term trader, you can get in and out. That's about the only people that will profit in that kind of an environment. It's very difficult for long-term investors because I always personally, emotionally, I always feel like selling them at the bottom and buying them at the top. That's my natural human nature. So like yesterday, oh my God, I'm wrong. It's going to go up. No, and then boom, it goes down today. So don't let your emotions get in the way of this volatility spike that we're in the middle of, and sell the rallies. I think it's a time to be short. It's a time to be short the FANGy kind of stocks: Tesla, Apple, Amazon, Microsoft, Nvidia, AMD, and just try not to get torn up. Don't get torn up by the volatility. Sell and short into rallies like we had yesterday. Generally, one rule of thumb, I'll end it here, is 3 days. If you've been in a collapse, you can get a recovery for like 3 days in a row or something. So that's a good thing to keep in the back of your mind. If you go down, if you have like 4 big down days in a row, then the market could bounce for like 3 days or something. And then you can use that to modify your exposure. Maybe if you're super short at the bottom, you might want to lighten up a little bit and try to put some more out after a rally. But that's dangerous too, because you could miss the crash. And I got to say, this will be my final comment here. This compares very similarly to the lead up to the 1987 crash. Back then, in terms of the bond stock ratio, so the bonds and also the monetary framework. So Greenspan came in as the new Fed chairman. This was when I was at Salomon Brothers. I'd been there for a year, kind of learned this one the hard way. He started raising interest rates. The stock market went up all summer while he was raising interest rates. The bond market sold off long bond by 24%. It bottomed on October 19th when the stock market crashed. And so a 24% decline in the long bond was enough to crash the Dow. And then we saw a major asset allocation shift. I talked about that last time, a couple of days ago, where a big pension fund, liquidated their whole position through Salomon Brothers. Anyways, what now? The TLT bond future is down 30% after today, more like 32% from in the last 18 months, and it's down 24 after today, now more like 26%, which is slightly more. That's in the last 7 months. So we've had a similar decline in the bonds as preceded the 1987 crash, and we've got all the similar kind of things. Inflation spike, the Fed's raising interest rates, blah, blah, blah. So something's going to break the back of the stock market, the decline in bonds. And I would be careful about shorting bonds here. I know, George, you said but everything's going down together. But in 87, when the stocks really started crashing, the bonds rallied like crazy. And Tudor Jones actually he's on record as saying he made more money being long bonds in the 87 crash than he did being short stocks. So just keep that in the back of your mind. We're not there yet, and I'm not long bonds. Don't get me wrong. I'm kind of neutral, but I'm looking for the bond market to find a bottom and for asset allocation moves to move out of stocks, crash the stock market, and for bonds to have a tradable rally. That's it for me. Thanks.
Thanks, Michael. Wow, what a tour de force. I think I'm going to go slit my wrist right now. If you guys could just stay there. I mean, Jesus. Wow. So, Michael, if you wouldn't mind just hanging out a bit, I want to work some of our other really smart speakers here into the mix. We're going to do Tony Greer, Tom Thornton, and then I see we've got the wonderful Michael Kantrowitz on stage as well. So, Tony Greer, welcome. I haven't talked to you for a little bit, but we email back and forth. What's your take on current state of affairs?
So, you can hear me, right, George?
You're good.
Perfect.
Yeah, we got you.
Sean.
Cool.
We got you.
Making sure. Thank you. I have a new headset on, so I'm testing that out. So, first of all, I like continuity, so I want to speak a little bit to some of the points that Michael made that I very much agree with. The sentiment that I pull out of his call is, the risk in big tech stocks. I screen for the same exact thing. Especially we'll start with unchanged on the week right now, looking for the excuse to go down, and with the market ending up lower, that's kind of the great rotation that I've been preaching, where natural resources can rally, natural resources stocks can at least rally or stay sideways, and you see everything tech literally coming apart and just revaluing to something a little more reasonable. So Michael had an allusion to the 87 crash, with bonds crashing while bonds rallying while the stock market did. I have an allusion to the 2000 crash that I just got from Jason Gephardt, who points out that last time the market rallied over 2.25% was a day that the Fed hiked rates was 2001. And I tried to remind everybody in my note today that from that point, when that happened in 2001, the S&P rallied 15% and then got split by 40%. And that sort of rhymes with everything that I see happening now. And the reason that I'm getting such strong conviction on this is because when I dial into my daily lens, my weekly lens, and my monthly lens, they all send the same extremely powerful signals. So if you look at today being a huge immediate reversal of the post FOMC bounce, right, with 30-year yields gone wild today, trading to a new high, caused a lot of selling in the stock market. So the beginning of that asset allocation that Michael was talking about, or at least some early inning of it, we had a tick index low print of minus 1728. So there's really hitting bids today. And what's leading, what is shocking right now to some people, and probably not enough to get them to get out of the position yet, is that we're seeing things like 2 sigma free falls in Apple on days like today, right? The cloud storage sector evaporating for 7% today, now down 3.5% on the week. You want to talk about things that are teed up to get crushed into Friday's close, Michael? Holy smokes, look at some of the subsectors of tech. There's no way these things are getting out of this rate hike confirming week alive with the small losses that they've posted, given the charts given the way the charts look. Like Internet FANG software off 6% today, 2 sigma falls in cybersecurity, 2 sigma falls in home builders. It's like the market woke up and was like, oh yeah, we're in a tightening cycle. Let's not forget that. And the rotation just came alive. And then if you zone out to a monthly performance, George, you get, let's look at April, which just closed really quick because, I'm a total junkie for performance. FANG was off 22%, FANG complex, right? That's a bear market right there. It's already off 30%.
Yeah, Tony, hold on.
Yeah.
22% for FANG in 1 month. That's a mind-boggling number.
You want to hear the breakdown, George? Let's go through it.
Yeah, go for it.
Let's go really quick. Netflix cut in half from 375 to 190, off 50%. Imagine the fucking institutional orders that came along with that. Take $1 million for sale, use a 50 low, like 50 what handle, right? Amazon off 23% in April. That's general number 3, shot and bleeding out on the battlefield. Google off 18%, Tesla down 20%. Facebook, Apple, and Microsoft escaped with little 10% haircuts like that's nothing, right? So here's another sign of the great rotation is that tech gets slaughtered. The NASDAQ 15% loss, S&P off 9%. Why? Because the natural resources sector is holding it up. We see the same thing in the macro world that we saw today, last week, and in April. Dollar up, commodities up, treasuries mangled. And I'm not saying that's going to continue forever. I'm just saying that's a continued sign of that rotation. And we see natural gas at the tip of the commodity spear with a 20% rally in April to be complemented by like a 20% plus rally this week, right? And that's the thing that's going to start breaking shit. That's the thing that's going to send food prices into, the next stratosphere and cause all kinds of, public strife. But humanitarian issues that you try to address and I love. But let's go back to the market, man. All I could say is that when I get confirmation on the daily, weekly, and monthly performance, that everything is like student body, great rotation, man, I get confidence to put that trade on at the right times, like Michael said, on rallies, et cetera, et cetera. And I think we're going to see a lot of opportunity along those lines right now. There's nothing to me The last point that I want to make, because I don't like to drone on forever either, George. The last point that I want to make is that, we saw the Federal Reserve kind of throw this alley-oop. We're not going to do 75 basis points, manufactured dovish statement. And all I could say is that the commodity market never left its feet. There's nothing, it shows nothing but signs that the central banks have got no control over the fact that we've got low inventories, rising prices, strong demand, and complete political attack on supply basically now across the commodity complex. And so that's something that should not really leave anyone's mind, because it's going to turn out to be a situation where the Fed's so far behind the curve with that situation can still spiral out of control. And so that's leading me to, stay long natural resources, oil and gas, energy and exploration, and, take my pot shots being short technology, because this trade is really, really confirming itself 8 ways through Sunday. And that's all I wanted to add to this conversation. And I love you for creating so much value. We can go wherever you want from here.
Yeah, Tony, just hang there. This is murderer's row here. Okay, so batting third, we've got Tommy Thornton in the hole. We got Michael Kantrowitz, and then batting fifth, we're going to go to Bob Justice, who's going to tell us probably a little bit about credit. So, Tom Thornton, you made me do it. I was so tired after the last couple of days. I wasn't going to do a room. But then the bullpen phone rang, and I was like, all right, get my glove, get back in use can't leave. So, Tommy, I thank you for being the driving force behind creating this room. Good to see you. What's up? What's on your mind, my friend?
Well, hey, gang. Hey, George. Thank you for putting this on. I think we almost have 1,000 people here, and it really solid comments from Michael and Tony. I just have to say, I learn something new each day, and coming into these spaces, and I've really been just humbled by that. Just everybody every day has got to learn something new, and that's the point of this, because this is a journey, and there's a lot of people that have never seen this type of market action before. And I've been through a few. I actually was an intern in 1987 at Drexel. I didn't know anything about the stock market, but they put me on the desk and to just relay fills for customers. And it was so hard because people didn't get their fills on things for almost days, and they had no idea what was going on. But so I've seen a couple of these, and I've also I worked for a $5 billion hedge fund. I was a senior trader, and I did all the technical analysis and sentiment work for the firm. And we did really well in 2008. We were set up for it properly, and we were flat in 2008, which was a 500 basis point difference from the S&P. So kind of what I'm seeing right now is that similar to what Michael's saying, that we're getting into this increased volatility reign, and a bear market. There's a misnomer about a bear market. They're terrifying for bulls and bears, because you never know when you're going to get yesterday, and you're going to get these rallies, and you get people instantly on Twitter that DM you that you have no idea who they are. They're anonymous and saying face ripper rally coming, you idiot. Yesterday I kind of looked at all the internals, and I really thought about what happened and why the market rallied, and it if anything, let me back up a little. Last week, I reduced a lot of exposure. And as a hedge fund person, when you get into these volatility type environments on the upside and downside, you reduce your risk. That means you take down longs and shorts. So I've reduced longs and shorts. And I cater to a lot of people that are, they can't handle the risk like I can, or I've experienced. So I reduce my risk. I have a lot of cash right now, just sitting tight. I have longs and shorts. I've put spreads on Qs, SPYs, and to hedge myself out. The main thing in this type of environment is not necessarily to say, hey, I'm going to be, the next Paul Tudor Jones and be a hero because yesterday's happened and you get wiped out. And so I have preached and talked about it on this space. Make sure your sizing is proper, small. And if it works, it's going to be just fine. But trying to be a hero can be, a real difficult task and almost impossible. So I'm seeing a lot of liquidity problems right now happening, and it's been a very low liquid type market. And when you're trying to move a lot of shares of something or a big position, you're going to move the stock a lot. And that's really what we saw today. There was a big de-risking happening today. And there's most likely a few funds or a few pods of prop desks that are just saying, hey, just eliminate your portfolio right now. Just take it down. I don't care. Just do it. And so we saw a lot of that today. But here's the thing. Yesterday, and I don't watch CNBC, so I don't know really. I stopped watching CNBC because I need to save brain cells and I stay focused on other things. And I like Bloomberg TV. They actually talk about markets, not just stocks and what stock you buying today, that kind of stuff. The bond market yesterday, faked everybody out, and then today everything sort of came undone. And I think there was probably a lot of funds last night or yesterday that were thinking we need to take down risk. And when you take down risk, that means you got to take down risk in every single asset you have. So it's not necessarily, oh, we've got to reduce our technology exposure. No, you've got to reduce everything because firms want to survive and they need to take down anything that's not nailed down. And that's why you saw you saw Bitcoin, fall apart today. And I've been, negative on Bitcoin for the last couple of weeks, and I think it can go lower. I think everything can go a lot lower, and we're right at the March lows. Now, we made a lot of 20-day, I don't have all the data, but I saw a lot of ETFs that were making 20-day lows. And Michael looked at the 52-week lows and highs. And, in this type of environment, you might want to, what I've done, and it helps me, is I look at 20-day lows, 20-day highs. And that gives me an indication of near-term movement. And we didn't get a lot of 20-day highs yesterday. We got a lot today, but we still haven't really broken through. And I have been saying since George, the first time you started doing spaces earlier, first quarter, I said, this is going to be a year where you're going to see lower highs and lower lows. And we're starting to see that. Now, this move down, we've been really, really holding this level here, the 4,100 level, 4,000. I mean, we're above 4,000, but it's really, as Michael said, a potential for a waterfall decline. Now, that's very possible, and if things break a little bit more, combined with lack of liquidity, this is all very, very possible. So this is my thought. Take down exposure, wait for stability. If you're going to buy some things on rips, buy them. Don't go big on size. Be tight on your stops if you're trading. And I promise you, and this is the thing about hedge funds, and it's like sausage. Okay, you love the taste of sausage, but you don't want to see how it's made. You make a lot of mistakes in this type of environment, and if you make a lot of little mistakes, you're going to be okay. I make mistakes also where I sell too early or I short something and it could go down a lot more. I shorted DoorDash and I covered it at 150. I wish I still was short that. Whatever. I don't look back. I try to make what I can when I can. And this is a market of mistakes. And you want to make sure that your mistakes aren't catastrophic, where you get too far on one side. Stay, have a healthy dose of or serving of cash on the sidelines where you don't necessarily need to put that to work. It's surviving these types of markets that's going to get people to the next level. And you can be a hero, you can be Paul Tudor Jones, but I'll tell you something. You don't need to. You may want to, but you don't need to. You're not going to get anything further other than higher risk, higher anxiety. And so right now, technically, I look at DeMark indicators, and I've been talking about the sequential, which is it goes to 13. The numbers go to 13, and the S&P and the Nasdaq 100, they've been the guide, and those are only on day 8 or 9 of 13 days. Now they don't have to go all in consecutive order, even though it's called the sequential, the most poorly named indicator in the world, but it works. So you could see some bounces, but I think we're going to see that move a little lower. Now, one other thing, if we're at day 8 or 9, the 13th bar, the 13th day, has to close under today's close. So that's something to keep in mind. So you could go sideways. I mean, that's the best case scenario for the bulls. And then we get that 13. But the deeper risk, in my opinion, is that we will go lower, and you will see more CNBC markets and turmoils, and you won't have people eagerly looking to buy or telling you there's a face ripper rally coming. And that's kind of what you want to see. You need to see fear. And I stress to people that, this is a very, let's say I'm from California, it's a very gnarly market, okay? It can really wipe you out very quickly. Leverage, forget it. You do not want to be levered. You want to have cash. You want to be conservative. Take your shots. If you're right, you'll make plenty of money. If you're wrong, you want to make sure that you're hedged, or you're not going to be stubborn, and you get out. So right now, my view is it's gnarly, and the big take is we could all be sitting here today or talking here tonight, and this could be the low. And if it is, we'll adjust and we'll move forward. But right now, it's not, and it may not be a V bottom as a lot of people in the last 10 years have been accustomed to. This is a different look, and I've seen it in the sentiment readings that you're not seeing V bottoms, you're seeing choppiness on the lows. So sentiment is a condition. Forget about how many people looked at the AAII poll over the last month and said, "Oh, it's making a low"? That's a crappy poll. It says, are you bullish, are you bearish, or are you neutral? So think about that. You have an excuse to be. You don't want to make a stand. You want to be neutral. That's wrong. So yeah, okay, everything gets low in sentiment, but it can stay low. It can stay low. It stayed low for over a year in 2008 to 2009. In 2009, nobody wanted to buy. People thought Bank of America at $4 was going to zero, okay? And it could have. But the point is, it's a difficult market. It's not one for heroes. And if you want to survive, play small, play tight, and protect your capital. And that's what a hedge fund is doing right now. That's what every smart hedge fund is doing. If they're still levered and they're over their skis, you look like Tiger Global. And you also have another thing, and I'll leave it this way. Liquidations in illiquid markets aren't good. And if you, to say the least, and if you have a SoftBank who has a lot of supply on their shelves that are just getting killed, and you know the names, they could have a real problem. And they're levered. They've always been levered. So there's still those funds out there that have risk. And that is when things really get dangerous. And we haven't seen any bodies come up from the surface. We haven't seen funds we hear that funds are shutting down. Even stupid Melvin is still alive. They haven't shut down. So we need to see funds shut down, liquidated. We need to see the bodies rise and say, okay, that's what you see towards lows. And again, I don't watch CNBC, but I'm sure somebody can tell me that the CNBC markets in turmoil, what do? Well, you don't panic. It's too late for that. And when somebody says don't panic, it's way too late, and you should be selling, because it's that's an excuse to say, please hold, don't sell. It's wrong. So take down risk to make your life and your sleeping happier and healthier. There's going to be plenty of opportunities on the long side, and I can't wait for those. I am chomping at the bit to get out there and buy some things, but I know better. That's it.
Thanks for that, Tommy. It's fabulous. Wow, what a wow. And again, with the last words you uttered, Tommy, reminds me of John Roque was referring to, I think it was Richard Russell's famous line about, in a bull market, the hardest thing to do is stay fully invested. And in a bear market, the hardest thing to do is stay out. No truer words were ever spoken. Okay, we're going to go now to our good friend Michael Kantrowitz, and then we're going to talk, then Bobby Justice will weigh in on credit. Michael, good evening. Good to see you again. What's going on, my friend?
Hey, good evening. So it's pretty easy to be bearish today, given notwithstanding what you just said. And I've done this long enough, not as long as you, but I've seen enough in my short career that, I always want to question when things seem so obvious and so consensus. Where could I be wrong? What could go wrong? I.e., what could stabilize the market here? And I think one thing that's not appreciated by the investment community is just how long this bear market's going to last. And we've kind of we've got a double bear market on our hands. In other words, we've got an inflation bear market that's playing out now, and then we're going to have a slowdown or recession, whatever you want to call it, a growth panic that we're only in the second inning of. So I do not think that we will see the low in the market this year. I don't know exactly how it's going to play out, but I think the worst pain in the market and the lows in the market will be around the lows in the economy, which is not going to be this year. It's going to be some point in the middle of next year. And that's just going by all these shocks we've had, from the dollar to oil to rates, long, short, and everything. All these things play out with a long lead time. We've talked about this. And so what we're seeing in the economy now is a reflection of what rates, oil, global central bank rates were a year ago, 15 months ago, when they just started going up, which is why we're just starting to slow. And this is going to, again, last for a long time. And so I think, we will see bear market rallies, as you normally do. And so that's, the only thing that's kind of keeping me from kind of going full bear, even though kind of everything's telling me to, is, the number one risk in the market today, the number one concern in the market today is inflation. It's not growth yet. If you look at CPI, we're 2.5 standard deviations from normal, just looking back over the last 3 years, 5 years, 10 years. When you look at economic data like PMIs or earnings expectations, we're kind of at the average level of the same period. So just by those metrics alone, we can say the market should be and is more concerned about inflation and interest rates than it is about the downside risks to growth today. And when the biggest issue, the biggest fear in the market, which is inflation and by extension rates, what I'm not concerned about, but just what's giving me a little hesitation in the near term is and just looking at the math, is the next 2 to 3 months, if not next month, this Wednesday, we're going to see a downtick in CPI. And I'm not trying to make a big CPI call because obviously it's going to remain very elevated. But that's not a bearish thing, right? It's a bullish thing with very limited upside. And then what if we get 2 CPI prints that are lower? And given how high CPI is, it's not going to really mean a lot for the Fed. It means they probably won't go 50 in September, which right now I think the market's pricing in 76% odds. They go 50 in September, so 50 in June, 50 in July, 50 in September. And that's the only thing that's kind of keep me from going full bear right now, is in the next few months, we see some incrementally better data on there. And given how lopsided that has been as a focus, and how that is by far the biggest standard deviation of any bad data point we have today, that could, as we saw yesterday, we could see more of those. And again, I'm not bullish. I'm not trying to. I'm just trying to think where we could be wrong, where I could be wrong, and what may make this last longer. Because again, the economy, as I see it, is just starting to slow. Earnings expectations are just starting to come down. Next earnings season is going to be a shit show. And you're going to see them incrementally get worse. And so, like, if the market just crashes, unless anything's possible here, as Michael was saying earlier, not sure what to do with that, because I don't think markets bottom because they get cheap or they get oversold. I think they bottom when the biggest problem facing the market goes away. And right now it's inflation, and it's going to increasingly be about growth concerns as well. So I'm kind of in the camp here. I think there's plenty of time to be bearish. Again, part of that's part of the reason why I'm not trying to be overly bearish right now is I think there's a long time to be bearish. Again, I think we've got another 12 to 15 months of weaker PMI data around the world. So I don't think the market bottoms this year. And I think I just want to be careful about not getting too overly bearish, knowing that the deeper, the worse consensus gets, the worse sentiment gets, the more the market goes down, the more you're going to see more you're going to see volatility on up days and down days. Volatility tends to increase as markets go down in a bear market. Those relief rallies and counter trend rallies tend to get bigger the deeper you go. And so stocks are certainly down. One of the things I would do and I'm doing with my money is I think you want to stop shorting, or if you're going to be short, I'd rather start shorting small cap value or small caps and take some money off the Qs if I'm short. Want to look for things that are more economically sensitive, because again, most of this year's pain is due to higher inflation, not slower growth. And as I've been saying, like a broken record with you, George, is that we're starting to see the implications or the byproduct of all this increases in rates and inflation. That's been now at least a year of rising rates and rising inflation, if not more. And so I think you want to start to not just press large tech or junk tech. I think if there's an upside risk to the market, like we saw yesterday, it's going to be the Qs that outperform. If we get any kind of CPI data that's even a little better, you're going to see the Qs do better, because that's what's down the most, and it's down the most because of inflation and interest rates. So if I'm wrong, if we're too bearish, if we get that, I'd rather be short something small caps that's not as beaten down because of higher rates, or it's not going to bounce as much because of higher rates. And if that doesn't play out and inflation stays hot, I think, and the economy just keeps getting worse and worse, small caps are toast, even though they've outperformed large cap growth year to date, because again, I would say it was mostly inflation, whereas over the next 12 months, I think the bigger risk is growth to the downside. So that's my 2 cents right now. And again, I think there's so much time here. Calling a bottom, I think, unless we're talking super short term here, I just don't see how the market bottoms. Earnings haven't even begun to get revised lower.
Wow.
Hey, Michael. I'm sorry to butt in
Yeah,
here, but I think it's kind of timely because you made some great points there. I do agree with you. I think you're probably going to see the CPI moderate a bit. It's not necessarily going to, because there's a lot of year over year stuff as well. But Jim Bianco's in here, and I hope we can hear from him as well, because he's like an encyclopedia of all this stuff. He knows everything. But how is the market going to react to weaker economic data? Because I see that coming down the road.
Yep.
And if the market reacts positively, they're assuming that the Fed is are they assuming that the Fed is going to slow down their rate hikes?
Yeah.
Are they going to slow down QT? Because I think QT is going to be the big deal, and maybe they'll go 50 basis points next month. If the market gets shellacked in the near term, maybe they'll do 25, and maybe they'll just stay on a 25. But the QT thing is going to be the issue. But I really want to know. I'm trying to gauge this. I thought about it a lot today. How is the market going to react tomorrow if, let's just say, the jobs data comes in a little lighter than expectations? Is that a good thing? Because to me, it seems like that's the big question.
Yeah, no, that's actually a really good point. I have not. You bring up a really good point where there's times in the market. I can think of 2015, the first half of the year, which is exactly what happened. 2015, the market was up about 3-4% the first 6 months in 2015. And similarly, that was right at the beginning of the last tightening cycle. The Fed was supposed to raise rates, I think, 3 or 4 times that year. They ended up not raising rates till December 15. But I remember vividly in the first 6 months of 2015, the U.S. economic and global data were terrible. If you look at the City Surprise Index, you can just see the beginning of the year, it just tanks. The only strong data we got was employment data, because employment's a lagging indicator. So while the employment data is kind of slow, it'll probably be the strongest of all economic data, just because it's such a lagging indicator. And we haven't seen profits collapse. You're not going to see employment collapse yet. So you bring up the point that sometimes you get to a point where weak data or bad data is good news, right? Which I hate, because I always believe, bad data is bad and good is good. But when you got the Fed in play, you can get some weird stuff going on in the markets. And so, I haven't. Actually, you're the first person to kind of mention that as a, given that this inflation issue is such a supply issue too. I'm not sure if slower growth will get that effect as it did in 15 or even the beginning of first 3-4 months of 2011. But the data's been weakening, and I think, again, there's 2 trades going on the market right now. It's very bifurcated. You've got the risk-off trade from a lot of cyclicals or underperforming defensive counter-cyclical names. And this has been going on for over a year now, which is when PMIs peaked and that trade peaked. Really simple poor man's way to look at it. Just look at high to low beta, the S&P, SPHB, and SPLV. I think it's the high and low beta or low volatility index. That's a real good proxy for it. And it's something that I'm short high beta and long low volatility. That spread in the last 13 months has generated about 23%. That's also the most consistent factor around economic data. So if you want to try to isolate out the risk of inflation getting a little better, or trying to pull that out of your portfolio, because it's going to create a lot of volatility, and maybe we don't know, but I have super high conviction that the economic data is going to slow for a lot longer than inflation is going to rise at this point. A poor man's way to do that, short machinery, long staples, or short high beta, long low volatility. And those trades are playing out beautifully as they normally do. It's high to low beta is a very macro trade. So it tends to move with PMIs really closely. And it's only down 22% from the highs. And it's really starting to melt down the last 2 or 3 months. If you go back to the last 3 slowdowns in the last expansion, the bottom in 2011, the bottom in 2015, the bottom in 2019, high beta underperformed low beta by 30% on average. In the recessions, it underperformed by 60 in 08 and 80 in 2000, 2001. So to me, I have a lot more conviction in that trade, sleeping better at night, not worried so much about the CPI print over the next few months. I think it's going to continue to be a risk-off market as the data go down. But your question, how much is the market going to care? The problem today, and this is, again, another reason why I'm not full bear yet, is that the data is slowing, but it's not, European PMIs are still in the mid 50s. Yeah, they're going to 40 or even lower over the next 12 months, and Europe's going to be in a recession. The U.S. is going to get darn close, if not be in a recession in a year. And I think the ISM is going, to low 40s. We're at 53.5 on new orders today, but it's not horrible yet. And you're just starting to see employment weaken. The Challenger jobs data year over year. Michael Green posted this today. I retweeted it. You're starting to see layoff announcements pick up. A lot of them have been tech and COVID winners, and you're starting to see it also in the housing sector. And that's very normal in terms of how the evolution of a slowdown plays out. It always starts off in housing first, where it's visible from both an activity and employment side, and you're seeing that. So I think given that the economic data today is slowing, but it's still in a decent level, I don't think people will panic about it yet. Or maybe we do get to a period where you do get weaker data from here and people view that as bullish, but I don't know, because it doesn't, it's not demand that's driving much of this inflation at this point. And if it was demand driving it, I'd say, yeah, you get the bad data as good news like you did in 2015. But given that there's such a supply issue, given that there's kind of an intermediate term, multi-year bull story for the energy sector and other commodities, we may just kind of skip by that and just at some point just get bad data is bad data. And I think it's going to take another 3 to 4 months of weakening data and lower levels on these economic data points and a lot of earnings misses, which probably start to really show up next quarter more broadly, to really make downside risks to growth the dominant driver of markets, which is not the case today.
Michael, that's really, really brilliant. If you don't mind, Bobby J, I'd like to just change the order a little bit, just because we were getting up ahead of steam on this inflation question. And I'd like to bring Jim Bianco into the mix to weigh in on inflation. Jim gave a fabulous presentation last week at the CMT conference, and so he definitely has opinions about this. And I think we would all benefit just to hear Jim's opinion right now. So, Bobby J, if you wouldn't mind, I'd like to have Jim weigh in now. So, Jim, good to see you. What's on your mind, my friend?
Hey, good to see you too. This is, I guess, I've only been here for about 7 minutes, so I missed a lot of it. So forgive me if I'm going to be a little bit redundant on what might have been said.
Jim, I'll just give you the Reader's Digest executive summary version. The overwhelming majority of the room, from all the smart cookies that went before, all massively bearish and looking for major downside. Damning him with faint praise, Michael Kantrowitz is actually the most bullish speaker so far. So that should kind of give you the tone of the room. But go ahead, Jim.
Yeah, I'll make a quick comment about inflation, and then I want to make a comment about the action that we saw today too. The comment about inflation is there's, in every inflation episode throughout history, there's always been a supply constraint aspect of it. In the 70s, famously, what kept Arthur Burns and G. William Miller on the sidelines was they kept mumbling to themselves, this is about an Arab oil embargo. There's nothing wrong with the economy. We don't need to deal with this inflation problem. As a matter of fact, Stephen Roach famously talks about that when he worked at the Fed in the 70s, they created core inflation, the core inflation measure, precisely to try and dispel this idea that there was a secular inflation problem in order to not deal with it. So this idea that this is all supply, every single inflation episode in history has a supply component to it. There's also a giant demand component on this inflation problem. And I'll give you 2 statistics on the demand side of the equation. Statistic number 1 is the OECD, the Organization of Economic Cooperation and Development, has 30 countries that they harmonize, the 30 developed countries that they harmonize the economic statistics for. Core inflation. The highest core inflation in the world, on the developed world, is in the United States. That is rare for the U.S. to be one of the outliers, the highest or the lowest. We're always somewhere in the middle. The San Francisco Fed and the IMF have done studies and said since 2020, we stimulated far more than any other developed country in the world. As a matter of fact, we were the only country that saw median incomes rise during the pandemic. That's how much we stimulated with all the checks that we mailed out. Everywhere else, median incomes fell, and they stimulated to manage the decline. But we went the other way. People became richer during the lockdown as well. And I'll give you one other statistic. I've said this here before, and I'll correct myself. It's from Zillow. I said previously it's from Redfin. The chief economist at Zillow points out that the median income in the United States is $50,200. So 50% make more than that, 50% make less than that. The median home price rise for the year ending March was $58,000. First time in history, the median home made you more money than your job. That wasn't even remotely close in 06, 07 when we had the housing bubble, but it is now. And so I think what you've got is you've got all this stimulus, out of control demand. Is the stimulus over? Is the demand over? A statistic I like to watch is Car Gurus, used car prices. They have a daily update on used car prices. I know everybody loves Manheim. The problem with the Manheim numbers, there's nothing wrong with it. It's just it measures used car prices at the wholesale level, at auction is where they measure it. Car Gurus measures daily what the median or what the average used car price is. And today it made a new all-time high. It peaked in January, went down hard into the late part of March. That was reflected in core CPI with the big giant drop in used car prices, which led to core CPI in March coming in at 0.3 instead of the 0.5 everybody estimated. But then used car prices turned around and shot right back up to the top. If you look at airline tickets and if you listen to the airlines on their conference calls, there is no slowdown in the amount of spending for people to go on traveling. There is no slowdown in the amount that people will pay up to get a car. So what can the Fed do about inflation? What Jay Powell suggested that they were going to do. I want to read you the opening paragraph, just 3 sentences, of Jay Powell's press conference yesterday. Before I go into detail of today's meeting, I'd like to take this opportunity to speak directly to the American people. Inflation is much too high. We understand the hardships it is causing, and we're moving to expeditiously bring it back down. We have both the tools we need and the resolve to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2 years and have proved resilient. It is essential we bring inflation down and we have a sustained period of strong labor market conditions that benefit all. So what he just said is I want to speak to the American people. And I think what he is saying is, I want to speak to those people that don't own stocks and don't own a house. I am going to bring inflation down. And how am I going to bring inflation down? I'm going to crush stockholders and I'm going to crush homeowners. I think that's the only thing he can do. And I think he set the stage for that yesterday. He erred by saying 75 basis points is not on the table. And that got kind of sucked all the oxygen out of the room. But I think that there was a reality coming back that it might be on the table. And the last thought I'll give you on this, and then I want to pivot to one other topic here real quick. If you look at the CME's Fed tool, so if you Google CME Fed tool, they have the probabilities of what the Fed's going to do at the next meeting. It's 83% that the Fed is going to raise rates 75 basis points at the next meeting. The day after he said 75 is not on the table. The market thinks he has no choice but to get very, very aggressive. Now, is the market going to be right on that? It could change its mind. It's 40 days away, it's the meeting. But at the March 16th meeting, Powell was asked if they would front load any of the rate hikes and consider going 50 at the March 16th meeting. He said that they were not discussing the idea of front loading. And the immediate reaction out of that meeting was there will be no 50 basis point hike in the May meeting. Then over the subsequent weeks, Bullard and the rest of the chorus came out and said, no, we should consider 50, and then they moved to 50. So it looks like the market is driving policy, not the Fed. And the market is worried that there's a big inflation problem, and it seems like it's demanding that this Fed step up the pace. I'll take questions on that, but let me pivot to one other thing. I'll quote Jason Gomford here. He put out a tweet today, which I thought was spot on, and I actually retweeted it with a comment. Today we saw the stock market down 3%, and we saw 10-year bond futures down more than 1% on the same day. That's only happened 2 other times in the last 25 years. The first time was October 9th, 2008, a week before TARP, when everything was hitting the fan. The second time was March 18th, 2020, a week before the bottom in the market, when everything was hitting the fan. So what does that tell you when both the stock market and the bond market are getting drilled hard on the same day? It smacks of some kind of forced liquidation. I've been tweeting out this chart of the global bond total return index, which is down 12% for the year. That's the equivalent of the S&P being down like 60%, is what that is in bond land, for the global bond market to be down that much. And I've been arguing that this chart is telling you there's a tremendous amount of pain in the bond market. Well, the action in the last 48 hours, with everything getting crushed, if it is something that can turn green or red, it seems to be going down, unless it's a commodity. But if it's a financial asset, it seems to be going down. Smacks of some kind of a problem in the market. Now, I don't know who or what or why, but when I look at the total return chart, it screams to me somebody or maybe several people are in a bad place. Now, the bullish thing I would give you on that is, historically, if somebody blows up, and that what I defined as blows up is that we get big splashy headlines that with a name and securities and a motivation for why they've blown up, and we get the Fed or Wall Street talking about what they're going to do about it, that usually occurs at a low. And so if we do get some story that somebody's in a bad place and blowing up, that would actually make me somewhat bullish, at least for the short term, because usually Bear Stearns, when Bear Stearns failed in March, that produced a low and a tradable bounce for 2 or 3 months. We made a lower low after that with Lehman Brothers, but you can see that happening. But for right now, leaving that aside, this market has written all over it, somebody's in a bad place right now. And you usually don't see both stocks and bonds getting drilled as hard as they have been the last 2 days without that idea that something is seriously amiss. And last thought for you on this, and I'll take questions. What does this all come back to? It comes back to an aggressive Fed, or a Fed trying to get aggressive, the market demanding the Fed get more aggressive to deal with an inflation problem. And I'll just point out what I like to point out about this. The mistake the Fed made, the policy mistake the Fed made, was last year by continuing to say the word transitory and not dealing with inflation when it first went to 3% in the spring of 2021, by doing the taper, maybe 25 every quarter, getting the ball rolling to take the steam out of all of the demand that we have in the markets. This year is the consequence of last year's policy mistake. So is the Fed making a policy mistake? It already happened a year ago. We're living it right now. And I don't think there's much they can do unless things go really pear-shaped, but they have no choice but to follow through on this aggressiveness. So those are some of my thoughts. I'm happy to take questions or criticism.
Hey, Jim, that was wonderful. One glaring question that just jumps out. I mean, every other sentence, every thought revolves around the word inflation. And just before you came in the room, there was a thought that the CPI number the next couple of months might be lower. Could you just give what's for we're just spitballing here, but it's 2 questions. A, what do you think is the trajectory of actually the CPI numbers the next couple of months? And then B, could you just repeat for the benefit of the audience? I really liked your definition that you promulgated last week. You had your own Jim Bianco homegrown definition of the word transitory. So if you could address those 2 questions, please. Thank you.
Yeah, let me start with that one. Transitory, what that means is the Fed, the government, the administration, you don't have to do anything about inflation. It will peak on its own, and it will recede back to its 2% target without any intervention. That's what transitory means. We don't have to do anything. I've been tracking a lot of the surveys. Right now, the economic surveys and the surveys of managers, and they've been asking this question a lot, is inflation transitory? I still think there's 33 to 40% of the street that still thinks inflation is transitory. Meaning, again, Fed doesn't have to do anything about this. They're just go raise rates for show, to pretend you care, talk to the American public like Powell did, pretend you care, but really, you don't really have to do anything difficult in order to make this go away. It will go away by itself. But now a majority of people do think that it is something more than that. By the way, I also think that my guess is that's probably in the Fed too. About 40% of the Fed thinks that inflation is transitory. It will go away by itself. And whether or not about the idea about it peaking, I'm open to the idea that 8.5% might be the high in inflation. If it wasn't March, it might be April, just because of the mechanics of the inflation report. But I think that that's irrelevant, whether or not the peak was then. I think the more pertinent question is, okay, now that it's peaked, how fast does it recede? If you're going to tell me that in September on Labor Day, that we're going to be in the low sixes, went from 8.5 to the low sixes on inflation by Labor Day, 75, 50, 75, and crank up the machine on QT and go and go and go. It will be no different response if we peak now and go to 6% by Labor Day than if we stayed at 8.5%. You get to 4, then we can start talking about, the Fed backing off. But the idea that the Fed will try to tell everybody, you can live with 6%, at least it's not 8%, I don't think it's going to fly. So the policy is almost set that for the next several months, they're going to have to continue to be aggressive unless something goes pear-shaped, or in the vernacular, something breaks and forces the Fed to change course right now. And again, all of this comes back to the idea that the mistake was last year, and this is the consequence of the mistake.
Thanks for that. Hey, Michael K., you got a question?
Yeah, it's a quick question for Jim or any of the speakers. Well, actually, Jim, what do you think could trigger at some point later this year, maybe next year, early in the year, the Fed or Powell explicitly saying or acknowledging downside risks to growth, which he's clearly not today?
Right. I think two things. First of all, if you look at the data today, right now, there is little evidence currently that the economy is in trouble. Yeah, we had the big negative GDP report. I get that. We'll find out with the payroll report tomorrow, unless it's a shocker on the downside. He's not going to admit that there is any downside risk, because what markets are forward-looking, and they're telling you that there's downside risk. And why do I say that? Because he was asked that question yesterday. And yesterday, not a lot has changed since yesterday in terms of the economic data. He basically said the economy was in a good place, and he said that labor was in a very good place and that the labor market was very tight. He said that a couple of times. At least twice he pointed out that there's 11.5 million jobs open in the United States, and there's 6 million unemployed people, and that we've never seen that many jobs over unemployed. By the way, I also think that's code from the Fed when he talks about a strong labor market, because what would get the Fed to stop with the rate hikes immediately? If you're making people unemployed. But when he keeps talking about that the labor market is very tight, and that he keeps talking about that we've got 11 million open jobs with 6 million unemployed people, he's saying, man, I can jam it up your ass with all these rate hikes, and I'm not going to make poor people lose their jobs. I'm just going to make equity holders have a bad month. And so watch me do that, is what I think he's been saying. Now, if that turns out to be wrong, and the economy does start to slow and unemployment does start to tick up, then I think that Powell will have to change course. But right now, at 3.6 or 3.5% unemployment, and assuming we get some non-zero number tomorrow, anything close to consensus, I think he's going to continue to say, like he said 2 weeks ago, the labor market's unsustainably strong, unsustainably hot. Like he said in March, the labor market can handle us raising rates, and that's where he's going to be thinking about it. But I don't think he's worried. Just like you're right. Everybody's talking about inflation. I watched the presser closely yesterday. There was not one question yesterday about growth. Every single question he was asked was about inflation. And even the inflation, even the growth questions were couched around what does inflation mean for jobs, or what does inflation mean for these growth statistics. So I think it's important to understand a part of the policy mistake was last year. This is the consequence. I don't think the real growth numbers play right now. It's the inflation numbers that play. And yeah, I think we're probably going to break something along the way. The bond market is saying we might be closer to it than we all realize for the moment. But this is the problem when you let inflation go to a 40-year high, is that it consumes the room. Because remember one thing about inflation. It affects 100% of the people in the country. Unemployment affects, if unemployment goes from 3.5% to 5%, it affects 1.5% of the population. And if you include their spouse and family, let's say it's times 4, 6% of the population. Inflation affects 100% of the population. And that's why it is something that you do not want to have get away from you. And that's what this Fed did. They said transitory too long, and they allowed it to get away from them.
That's fantastic. Three Aces, you got a question?
Yeah. Hi, guys. I'm just blown away. I mean, we've got 1,800 people in here, and we've got an absolute dream team on stage. I just wanted to point out a few things that haven't been talked about, and in the form of a question always, and just curious what opinions are. So, for me, today was the first real sign of selling, like broad-based, just nonstop, big time, kind of like forced selling. Which brings to question a number of things. First of all, margin debt, I think, is still about $250-300 billion above the pre-COVID high. Okay. Now, if I look at, Apple page one investors, I mean, you've got an investor in there that's got 1.3 billion shares. I mean, I've never seen anything like that. Where these concentrated handful of page one investors on Bloomberg have just these ungodly positions in these stocks, and if I look at, like Carvana as a canary in the coal mine, the capital markets are closed off. I mean, that thing's down 40% and the ink is not even dry on the confirm yet from where they were pricing that deal. So back to John Roque and George's presentation at CMT, if large cap tech is 40% of the NASDAQ or higher of the S&P and stuff like that, and we have this massive forced selling with this margin coming out of the market, I mean, we really have a recipe there for some very serious downside and stuff. Where does the money go? How do they get out? Where does the money go? They can't just roll that into commodities. I mean, the commodity complex is maybe 3 or 4%. Even energy, oil and gas is in single digits now where it used to be 15-20%. I just don't, how does this work? How do they get out? Does anybody have, just sort of just an opinion as to how that may work? To me, it just seems like it could be absolutely just the biggest bloodbath we've seen if that stuff comes together. Thank you.
Anyone want to take that? Tom Thornton, your hand's up. Do you want to take that?
No, I don't. I don't know where it's going. But honestly,
well, no,
sometimes
hold on,
I can say I don't know. But I do have a question for Jim.
No, hold on, Tommy. Let's deal with that question first. I mean, Three Aces. The elephant's trying to get out of the phone booth. I mean, you reminding me, that's a question, the types of what my grandfather always say, never ask a question you know the answer to. I mean, only ask a question you know the answer to. So I think implicit, I think you know the answer to your question. And the
They're
point
trapped.
is, it's a rhetorical question. The point is extremely well taken. Let's go to Tom Thornton, and then I
Money
want to bring.
heaven. That's where it goes. It goes to money heaven. Right?
In third grade speak. Thank you, Jim. I appreciate that.
Hey, Jim. Seriously, I know we make light of it, but it's a serious question. I always get this question. People say, "Where did the money go?" Like, how do you explain to people? How do you answer? Like, where did the money go? When the market cap disappears, like, where did the money go?
It disappeared, right? It was just marked up assets that was unrealized gains that became smaller unrealized gains. It never existed in the first place. It wasn't a pallet of dollar bills. If I it wasn't a pallet of dollar bills in my garage that somebody stole. Well, they're still out there in the system. It was just unrealized gains that become smaller unrealized gains. That's what I mean by money heaven.
100%.
George, to add to that, it takes money for the market to go up. It doesn't take any money for stocks to go down.
Yeah, bingo, spot on. All right, listen, Tom, you had a question, and I want to bring. Hold on.
Go on.
Well, hold on. I want you to ask a question, but then I want to bring Dr. Al-Haji in the room. We're privileged to have him. We haven't talked about energy at all. Rumor has it there was an OPEC meeting today. Despite everything that's happening, the oil price stays in there firmly, north of 100. Dr. Al-Haji was in our room with 3 aces over the weekend. I think it'd be great to hear from him, get an update on his views. So first, Tom Thornton, your question, and then we're going to Dr. Al-Haji. Tommy, the floor is yours.
Okay, this is for Jim and Michael. It's funny how Fed chairman or ex-Fed governors and vice chairman Clarita today, he came out and he was talking, and he said that the Fed funds rate needs to go to 3.5%. Now where are we, right? 75 basis points right now. I don't understand why the Fed governors, especially Dudley, who I have a lot of respect for, when they leave, it's like that Liar Liar movie where they automatically tell the truth about where things should be, but when they're in office or as a governor, they have to sort of massage things. And I think that what this market needs is someone that's going to be able to say what needs to happen rather than just poke around at it. And I think that would actually help the market with more clarity if a Fed, well, let's say Powell came out and said, we want to get to 3.5%. Maybe not there, but that's what Clarita said. So anyway, guys, I'm going to let you guys talk. I have a early morning tomorrow, so I want to hear what this is, and I'll be on for a few more minutes.
I guess I'll go first. The problem with the Fed, you're right. I've often said that the most important Fed officials to listen to are the ones that just left, because the filter is removed. They understand the organization. They don't need talking points. They know what's going on, and they can say the quiet part out loud. Dudley said it last month when he wrote his op-ed in Bloomberg that said if the stock market doesn't go down, the Fed has to lower it, meaning the policy of the Fed is to lower the stock market or tighten financial conditions is the euphemism that they like to use. And I heard Clarita come out today with his 3.5% as well too. I think it really comes down to the institution of the Fed itself. They are mistaken in that they believe they need unanimity in all of their decisions. That's why the vote yesterday was unanimous. We usually get these votes with maybe one dissenter every once in a while. No Fed governor has dissented from the chairman in 27 years. And so because they want this to be unanimous, that everybody gets assigned talking points to read. So they're never really allowed to tell us their own opinion. Look, the Supreme Court is going to hand down a very significant 5-4 ruling. No one says that, because it's 5-4, it doesn't count. Sure it does. It counts just as much as 9-0. The Bank of England just raised rates yesterday. They had a 6-3 vote to raise rates, the MPCs did. They've had 6-3 votes in Japan. But the Fed will not tolerate something like an 8-4 or 7-5 vote. So they've devalued all of the governors and all of the presidents by saying there's an institutional view. It's kind of like what we hate about Wall Street, right? It's an institutional view. Here's your talking points. Now go out there and read them like you mean them. And that's really what's happened with the Fed right now. They would be better off if they had a Judy Shelton at the Fed, if they had some heterodox thinkers that were saying different things. And if they wanted to come together and say the vote was 7-5 to raise rates, so what? But that's just not the way the Fed thinks. So we have to wait for them to leave and be unshackled, then tell us what they really think about Fed policy. So that's my 2 cents on that subject.
Hey, Jim, are you speaking
Jim.
specifically around Fed meetings and like press releases, or are you talking even while you get speeches that happen often in between meetings?
I'm talking about everything that the Fed does. Every speech that the Fed makes has to get approved. That's why there's all those speeches that they give are all written out. No one ever gives a contemporaneous speech. You have to, if you're a regional president or a governor, you write out your speech and you send it up the flagpole, and they read it and they then bless it, and then you go out there and you say it. So that's the way that the institution works. And the troika at the Fed is the chairman, the vice chairman, and the president of the New York Fed, and they're really the three that kind of set the policy, and everybody else follows along. And they'll go as far to tell you at the Fed that, what's the point of being a governor at the Fed if that's all if they set the policy and you have no say in the policy, and then you're handed talking points and go out and read it. They'll honestly tell you that, but as a governor, you get to schedule a meeting with Jay Powell, and you get to go into his office, and you get to argue your point of view. And Jay's body language will tell you he really cares about your position, but then they will anoint a policy, and then you're expected to just salute it and go along with it. That's why this institution constantly makes mistakes, because that's the way that they think about certain things. And everybody in the institution falls in line with this groupthink that they have there. And that's why they can't think anything other than the groupthink and outside of the box. Thanks
for that. Let's take a quick time out here just to reset the room. I have to say, and I'm so proud of this room, everything we've done here. I just tweeted it out. This is, I believe, the single greatest collection of intellectual capital ever assembled in a Twitter space. Just look at this lineup. You can't find a conference, the most expensive, fanciest, high-end Wall Street conference. You cannot find a collection of talent like this. This is free. I mean, it just blows my mind. Goldman Sachs, Morgan Stanley, Merrill Lynch, go pound sand. We got Twitter Spaces. Unbelievable. It's unbelievable. And, of course, I have to put the pitch in for the fact that, we're all doing this for free. Dr. Alhaji, Tony Greer, Michael Kandrowitz, Michael Belkin, Bobby J, Jim Bianco, Mark Newman, the list goes on, Tom Thornton. They're all doing this for free just to help educate people. And if you're getting value from this room, please give generously to World Central Kitchens, pay forward. None of us are lining our pockets with our time spent here. We're putting our talents to good use. Pay forward. We've raised, I think, oh my God, we've got a match in the pipeline, but I think we're up to, with some of the match we've used already, we're up to, I don't know, $140,000, some crazy number like that. Our goal is $200,000. We're really building momentum here. So please, if you're finding value from this room, please, and many of you have already given generously, please give generously to World Central Kitchen. There are people really in need. They're doing God's work. They're serving 300,000 hot meals a day to people in the Ukraine. There's 3.5 million refugees. And this is just extraordinary. And I don't know, Three Aces, this is just unbelievable, this room. Three Aces, I'm pinching myself. I presume you're probably feeling likewise.
I mean, especially when I read an Adam Jonas buy recommendation on Carvana. I mean, this is just an absolute dream team. And just to plug the kitchen for a second, You know, I grew up my dad was a cab driver, and there were plenty of times when there was no food in our house, and that was no fun. And in New York City, there, and this is not a political thing at all. You've got 3.5 million people who have basically been turned into refugees in Ukraine, and they have fled because of a man-made problem that was created by politicians. And many of them have lost their husbands, their homes, everything. And what Central Kitchen does is they're very, very brave people. They go right smacking in the middle of that, where all the gunfire is and everything, and they feed those women and children. We have a match from Alexander over the weekend who's matching $50,000. We've all donated 2-3 times here, but many of us have. So once we get to that match, about $125,000 or so, you'll see another 50 come in immediately after that. $5, $10. I think a meal is about $4 each. It all goes to charity. Anything that you can do to help here would be fabulous, and try to help these poor folks out that did not ask for this. They didn't do anything to deserve it. They're victims of man-made power, policy, and politics. Anyhow, George, I just wanted to put that in there. Thank you.
Appreciate that, Three Aces. And if you want to give, just look at my Twitter feed. There's a link there. It goes directly to World Central Kitchen.
It's in the nest now, George. I put
that's
it in
great.
the nest.
That's right. Thanks very much. All right. So one unbelievable room. I know we're kind of mixing the order up here, but Dr. Alhaji, great to see you. I understand it was an OPEC meeting today. Could you please give us sort of a mark-to-market update on your views, what you see going on with the oil market? Thank you.
Thank you, George, and thank you, Three Aces. Before I talk about OPEC, I just want to make this introduction. Since we are talking about inflation, recession, slow economic growth, stocks, etc. If we look at the period between 2002 and 2008, oil prices continued to increase until they reached $147. And looking at that period, we find out that continuous increase in oil prices have not affected economic growth, have not stalled economic growth in OECD countries, nor in China, nor India. And the question is why? Historically, we have the conventional wisdom saying high oil prices always lead to inflation and recession. So what happened between 2002 and 2008 that is different from the past? And what lessons can be drawn out for what we are in today? Well, it turns out that the period between 2002 and 2008 is the only period in history where we have sharp increases in oil prices and increases in government spending, military spending, increases in income, declining interest rates, declining dollar, and declining taxes. The wisdom out of this is high oil prices on their own do not cause a recession. But if you combine that with the proper fiscal and monetary policy, you end up with a different outcome from the wrong fiscal and monetary policy. What that means is if you go back to previous recessions where oil prices increased, it was the wrong policy by the Fed and the wrong policy by the government that contributed to the recession. It wasn't just high oil prices. And the idea here is how the Fed and the government is reacting to high oil prices. Increasing interest rates is bad. Reducing government expenditures is bad. Increasing taxes is bad. Now, people here in the United States think, well, we don't have any increase in state taxes or federal taxes. Well, I am here in Texas, and I know other states are having the same problem. Because of the massive increase in real estate value, and because the property taxes are a percentage of the appraisal of the value, we have cases here in Texas where a person will pay half of his income in property taxes alone. So in a sense, it's not only the increase in interest rate, we have increase in taxes too, resulting from the increase in the property value. And that's a major issue when it comes to a period where we have high fuel prices and high food prices. The other issue here is because when we look at 2002, 2008, that period after September 11th, where we have massive spending on security, we have massive spending on two wars, etc. And some people might say, well, we have a war and it's in Ukraine, and the West, Europe, and the United States are supporting Ukraine, and therefore there is this increase in spending. Well, there is a difference here. This is not really an increase in spending because most of the military equipment that is being sent to Ukraine is coming out of inventories. So it's not affecting employment and it's not affecting income. And therefore, we cannot count this as something similar to what happened after September 11th. The bottom line here is we are, based on all those variables and based on the past, we are heading for a recession. And if we end up with a recession, and probably faster than what people think, oil prices will tank. They will decline. And it is clear to me that if oil prices decline below $60, OPEC Plus will act again, and they will start cutting production in the middle of the recession. They've done it before, and they will do it again. Today, we have two major events that happened. They affect the market. I will talk to them in a minute, but I want to mention something about inflation that is usually missed when we talk about inflation and recession. Inflation, as you all know, is measured in a basket of goods. And the problem is it does not measure the quality of those goods. And quality been deteriorating for several years, which means that if you want to pick up any inflation rate, let's say 6%, well, when you adjust it for quality, it's way higher than 6%. And this is a global phenomenon, not only in the United States, simply because the quality of the products is getting worse and worse, and thanks to China for that. Now to go to the two events today that are important. The first one is OPEC been meeting on monthly basis, and today they met quickly. The meeting lasted for about 13 minutes, and they decided to continue with the plan, and the plan is to increase the ceiling. Please pay attention to this word. To increase the ceiling of OPEC by 432,000 barrels a day. We say ceiling because OPEC, in general, only few countries are able to increase production, and therefore the actual increase is not going to be as much as the ceiling. But at the same time, we had another issue, which is a committee in the Senate passed a bill which is called or known as OPEC or No to OPEC. This is an old bill that's from 2000, so it's been going on for 22 years. And the idea here is we have something called Sherman Act. Sherman Act, if my memory serves me right, started in 1892, and it was used to dismantle Standard Oil or the Rockefeller empire. And it was used in the early 1900s, and finally the government was able to break down the Standard Oil in 1911, and they broke it down into about 35 companies that include ExxonMobil. Now they want to use that by expanding the powers to include foreign nations, because foreign nations have sovereignty, and now they want to remove that sovereignty. So they want the Sherman Act to apply to Saudi Arabia and Kuwait and Russia and Mexico and all other countries. And therefore, any country that is accused of price manipulation or restricting trade will be subject to the law. And if they get sued by the Department of Justice, then they will be accused of some sort of monopoly. And then if the Department of Justice or the U.S. government wins in court, then they can force fines on those countries. And if they don't pay, then they can, and please pay attention to this, they can confiscate their assets to pay the fine. Now think of the implications of that. Well, again, if we are talking about recession, think about what might happen in terms of foreign investment within the United States as a result of this. This is not a law yet. It has to go through the full Senate. It has to go through the Congress. Then it comes to President Biden's desk. President Biden has a choice, either to sign it or not to sign it. Since it's coming to the desk by majority in the Senate and the Congress, then Biden has a problem. If he ignores it, it goes back to the Senate and the Congress. And if it gets 2/3 majority, it becomes the law of the land, even if Biden does not do anything. And if it becomes the law of the land, then we end up with the following situation. The Biden administration, if they are not interested in annoying OPEC members, what they can say is, okay, well, it's the law, but we are going to put it on the shelf. The Department of Justice is not going to do anything. And it's not going to do any investigation, and therefore they just table it in a sense. But if the Department of Justice becomes active and they start doing an investigation, and after the investigation they decided to sue, we have a lot of problems. This is going to take a long time, by the way, but we are going to have a lot of problems simply because they need to define the market. What is market? Is it exports? Is it production? Is it within the United States? Is it global? It's only what's on ships, what's in pipelines, etc. So there are many legal issues here, and whether it's going to be the government, like the government of Saudi Arabia, or it's the national oil company like Aramco. Is it KPC or the government of Kuwait? And if it's the government of Kuwait, is it the ministry or the king or the minister? Who is? So it's really kind of really tedious process to figure this out. But it is a serious problem. And the fear right now is if this passes and becomes a law, just like JASTA before, how MBS of Saudi Arabia will react, how the OPEC nations will react to this. Because there are many ways they can react to it. For example, it's as a simple fact, if they can use the same law, literally, in those countries and accuse Apple of monopoly. And it can use exactly, kind of mimic the court in the United States and accuse several U.S. companies, including the service companies like Halliburton and Baker Hughes, etc., using exactly the same principles, the same definitions, and sue American companies if they want to go that route. So we have a serious problem here because the fear is if this becomes the law of the land, then the oil-producing countries who are making tons of money right now, instead of circulating the petrodollars in the United States, they start shying away. And if they start shying away, probably they can even sell their investments in the United States. They have some major investments and leave. And that's going to affect economic growth in the United States. So we have a major issue with this in OPEC and how it's going to develop and what's going to happen next. The final point I would like to mention is, yes, everyone is talking about inflation, but I am not surprised. Yeah, I'm okay. Well, 7% is a little bit higher than what I expected. But we knew even 3 years ago that climate change policies are inflationary by nature. We did not know the extent of it. But now looking at some numbers, I mean, even electric vehicles, the price of electric vehicles went up for the same car, went up by 30%. Those green policies are inflationary by nature. And as we go and continue with those green policies, who is going to pay the price? Back to you, George.
Wow. You know, as if there weren't enough moving pieces on the chessboard already to listen to your words. It really gives one pause. There's just so many fault lines out there right now where things could go wrong. And you just highlighted another one. We've been speaking tonight in this room along the dimension of what's going on with inflation and classical economics and people are really paying. Not really. We haven't really. First, we really talked about energy in this room tonight. Although, as you know, Dr. Alhaji, we talk about it a lot. But specifically, I think it'd be interesting. And I'm not sure exactly how much the earlier conversation you heard, but when we were talking about CPI and where inflation is likely to go, and of course how what we're seeing in the oil patch is a result of underinvestment. It's a supply side. The Fed really can't do much about it. It might be interesting, although you and I have had the conversation many times, if you could just briefly repeat for the room's benefit your view on oil prices, what you see maybe perhaps for the rest of the year. Obviously, it's a fool's errand. It's always hard to predict oil prices, but as we look at the decreasing amount of excess capacity left, what do you think is likely to happen to oil prices as the year wears on? Thank you.
Thank you. Generally speaking, I am expecting unprecedented energy crisis. If you think we are in an energy crisis right now, we are just at the doorstep of it. We are heading for a major energy crisis for several reasons. And one of the reasons, one you highlighted, which we had a decline in investment in recent years for several reasons. One of the reasons, of course, is the decline in natural gas prices and the decline in oil prices. But we got to remember that the high by the International Energy Agency and the green movement, and when we talk about the green movement, I don't think anyone basically is against clean air, clean water, and clean environment. We are all for it, but we are really against those extremists and extreme policies. And we've seen basically many of those extremists basically being arrested and put in jail because they are taking extreme actions in terms of eco-terrorism or some terrorist actions taking against certain industries, including the oil industry. So we are talking about the extremists here. And one of the issues that we have the ESG, we have all those government regulations that all limited the ability of the industry to expand production. So we already know that we are short simply because we don't have enough investment. We have the divestment movement, and some of you already heard this several times from me, but I'm going to repeat it again. The divestment movement is one of the most stupid movements that we see now. And the reason why, because if you really care about the environment, you stay at the table. You care about climate change, you stay at the table. Why you are running away? Because you are selling your assets, giving it, from your point of view, you are giving it to the bad guy who really does not care about the environment, and he bought those assets from you. So you made the situation worse by divestment. If you want to have a say, you stay at the table. But the point here is, yes, we have a shortage of investment, and the Biden administration wants to increase oil supply and gas supply, and they are after the oil industry, and they are screaming and yelling all the time. But if they are serious, they really should look at the financing side, because that's what's stalling the oil industry in the United States right now. We need more money. And to get more money, then the Biden administration should talk to the banks and should talk to other institutions. If they don't talk to them, then this is going to continue. But the bigger issue that is not counted anywhere is that the big unprecedented energy crisis is going to happen because of the inability of the green policies to deliver. Yes, there will be some successes for the climate change policies, but not full successes like people are talking about. Let's remember the following. All those international organizations, whether the International Energy Agency or even OPEC, they, in their forecast, they take what the governments, what the members are saying, and they take it as given. Because you are not going to see an employee of the International Energy Agency telling the UK, you guys cannot deliver and you cannot do that. They are going to take what the UK is telling them, because that's the only way they can maintain the peace in that organization, and they can maintain the flow of money to the organization. They don't want to annoy those politicians, and then they will cut them off in terms of funding. So they take what governments are telling them as is, and this is a major issue because we have thousands of books and articles be written in the last 100 years. Sorry, I'm closing a door here. For the last 100 years, talking about government policy failure. And with those forecasts, they assume 100% success of government policies. But we know that's not the case. So this gap coming out of the failure is not being counted for anywhere. And therefore, the demand for oil and gas is going to be way higher than any forecast that exists today. And since we don't have enough investment, we don't have enough supply, then we are going to have a crisis, and prices are going to go through the roof. And oil companies that exist today are going to make tons of money, and investors in them are going to make a lot of money, more than anything we've seen before. But the issue is, if we end up with a recession, this is not going to change the medium and long-term outlook for oil. It's going to make it even worse. Worse in a sense where the crisis is going to be bigger and earlier, because with a recession, the investment that we are planning right now is not going to happen. And that's why I'm very bullish on oil and gas, of course, including LNG in the coming years, simply because of the logic that I just explained. For this year, the issue we have right now is the reshuffling of trade of oil and gas because of the sanctions that have been imposed on Russia. This reshuffling is inflationary because you are not following the most efficient way to ship this oil to its destination. Politics is involved, and therefore cost is going up. Yes, some of the Russian oil is being sold at a discount, but only a couple of countries basically are getting it. But the final consumer is not getting the discount. So when India buys a discounted oil from Russia, the final Indian consumer is paying the highest taxes in the world on diesel and gasoline. So we are not going to see the impact of that discount in the market because the government or the company that is buying them is pocketing the difference. Back to you.
Thanks, Dr. Al-Haji. That's always appreciate hearing you. Please stay on stage. I want to work a couple more questioners in, and I'm sure we'll have some more energy questions. I'd like to go to Bob Justice, who's been patiently waiting, and then Mark Newman. Hey, Bob, what's up?
Yeah, I just want to touch on something Jim mentioned and also Mike did before, and that is housing. Housing affordability is plunging. When I was at Bear Stearns in 2006, I was 5 feet away from the mortgage hedge fund desk. And what got everybody concerned was housing affordability. It had dropped to a 20-year low in 2006. And it looks like we have a toxic combination set up for to possibly get there again. And I'll tell you why. It's just two variables. One, we had the house appreciation to record prices at a very quick pace. And now we have a spike in mortgage rates that have more than doubled in a very short period of time. Right now we're at 540 on the 30-year mortgage, and it could be 6% within 6 to 8 weeks, especially when the Fed starts reducing their balance sheet, because the spread between the 30-year mortgage and the 10-year rate has already widened out by 100 basis points. So I think Jim is correct in saying that housing is going to be one of the tools in the Fed basket. And I see that this index, affordability index, has gone from 180 down to the 124 area, and it could be back to the 2006 area in very short order. And I wonder what Jim thinks about that. Oh, he's left.
All right.
No, I'm still here. You know, as far as Restate the question one more time you were asking about.
Well, now home affordability is plunging, Jim, and it's
Yeah.
because of the high prices and also this unusual spike in mortgage rates. The spread on 30-year mortgages to 10-year just widened out by about 100 basis points, and it could go another 50 easily when the Fed starts reducing their mortgage position. So I think we can be at 6% plus in mortgage rates, and that would bring the affordability index back down to par,
Okay.
which is not good.
Right. It's not good. The only thing I would say about the housing market, I said this on Saturday, and I'll reiterate it a little bit here. Something is going on with the housing market I don't think we fully understand. Going back to those, now going to some Redfin numbers. Redfin puts out a plethora of statistics on housing. And another housing number that's kind of caught my eye is that there are now about 55% of all homes trade above the list price. Prior to the pandemic, that number was around 15 or 20%. And as I said on Saturday, why do we hire real estate brokers? Because we want to know what our house is worth. And we want some expert to help us get the most for our house. Well, 55% of the homes are going above the list price. It says to me, real estate brokers don't know how to price houses anymore. Something has fundamentally changed with this housing market. This didn't happen in 2006. They knew how to price a bubble, and we were paying, and we still talked them down from the list price, but it was still an insanely overvalued price at this point. But something different is going on with this housing market that we haven't seen before. If I had to guess, I think what it is it's work from home, remote work. Because what is it if you're Toll Brothers or if you're Hovnanian or if you're any of the big home builders, what is it that you look for when you decide to build homes? What are the income? What are the job opportunities in that region? Well, that doesn't apply anymore because everybody works at home. You build houses on the top of some remote mountain, and somebody will go live there as long as they've got a good internet connection and electricity. And so I think what's happened with this market is it's fundamentally changed. Now, two things can be true at once. It could also be a bubble, and it could also burst with higher rates. But I'm still struck with this idea that brokers can't price these homes anymore. In fact, I've also heard that in some of the hot markets, I was in Santa Barbara about a month ago, and I was talking to a local, and he was talking about how hot the real estate market is. And some of the brokers were joking that maybe they shouldn't even put home prices on the home. It's just the home is for sale. Here's the open house. Just give me your bids, and we'll see where it goes from there. And it was almost like a tacit admission. I don't understand this market anymore. So I get it. What we're talking about with homes prices, but I think there's something more basic going on here if we can't figure out what the proper price is going to be. So I don't know if you've got a follow-up to that or any thoughts on that. That's been my take about home prices.
No, I think it is a bubble, and I think 75 basis points more in mortgage rates is going to start cracking that bubble. We'll see. I see more of a problem there than in corporate credit at the moment.
Thanks, Bobby.
I was going to say, I don't disagree with you. Two things can be true at once. It can be both different and a bubble as well, too.
That's great. Great observation, Bobby. Let's go to Mark Newman and then Guy Cirandulo. Hey, Mark, what's up?
Hey, George. Hey, everybody. Again, George, you just keep outperforming yourself every space. Just, keeps getting better. It's awesome. I just wanted to chat real quick about a little bit about what I'm a bit of a Fed watcher myself, and a lot of my guys I talk to think I sort of beat a dead horse. So it's good to hear guys like Jim, who clearly, I can learn something from even more about the Fed. And I wanted to touch base on some things he said. One of the things Jim said was what I actually talked about this morning with guys was that opening 3 or 4 lines, right, where he addressed the public, right? And then shortly thereafter, I think it was Steve Leisman asked the question about 75 bips, and that was it. He said no, and it was off to the races. But I wanted to speak about whether Jim thinks so. So I coined this phrase Fedability, and I call it Fed credibility, Fedability. And I've been talking about it for a long time. And I think that today, as Jim highlighted with that 83% number from, I think was the SIBO on the hike, 75 bips, it sort of showed a moment where the market really called bullshit on Powell, I think. And I think this is so this is where I'm getting to. So for a long time, when I spent my time in Japan, the BOJ was always really their policies targeted the assets as much or more than the economy. And it was like a short-term kind of thing, trying to keep the assets afloat. Not really, much like Powell did yesterday. He said, hey, American people, I really care. And then, of course, he was talking about the stock market in the end, and it moved as it did. And I guess I always, George, you and I joked the other day about OMO being not open monetary operations, open market operations, but we said they're open mouth operations. So Jim said something before about the unanimity of the Fed. And so I wanted to say two things. One was a question to Jim on whether anytime Lael Brainerd or anybody else speaks, Esther George when she used to, whatever, was that those are all scripted? I mean, I always kind of had a conspiracy thought that they'd make policy and then talk about it. And the talking about it was the open mouth operations that sort of George and I joke about, whatever. Jim, do you think it's sort of a script head to toe, start to finish? That's the one question. The second thing is earlier someone asked about sort of the, I wouldn't call it cataclysmic. Well, Belkin mentioned that word the other day, but the big rotation, how does it happen? Maybe it was 3 aces. I can't remember. But anyway, it would seem like there's sort of that Hank Paulson moment at some point, if it got really that messy, where they target all the assets of their friends and protecting their friends and say, we must do this policy now. So I wondered if, Jim, you thought what gets us to that moment, maybe A, and B, doesn't it make sense that like the bond market rallies on a flight to quality? So I guess the question is about the script, about that. Do we get a Hank Paulson moment, and is it the bonds that come back? Those would be my three topics for Jim.
So on the script, I think that they are scripted. Now, they're scripted in a way that, understand what it is that the troika of the New York Fed, the vice chairman and the chairman, they kind of set the policy. He told you yesterday they're scripted. 75 basis points is not on the table, and we were off to the races. Who decided 75 basis points wasn't on the table? Was it Jim Bullard that decided it wasn't on the table? No, it was Jay Powell. He decided it was on the table. They set the policy. Like I said, you are free as a Fed official to schedule and go into his office and make your impassioned plea for whatever policy you want, and he'll pretend like he cares what you're saying, but if he doesn't agree with you, you're not going to get that policy. Even leaving the Fed, you'll get some of the governors, and their speeches have to get approved. Usually they don't approve them for the policy, but they approve them for other things. You'll get some of the governors like Bullard to kind of, wander off the reservation and say something like 75 or 100 basis points is needed. But yesterday's vote was unanimous. You could jump up and down and say whatever you want, but at the end of the day, when it comes time to vote on the policy, we'll let one of you every once in a while, or maybe two if it's really, really necessary, dissent. The rest of you are expected to fall in the line and vote with what we want to say. And that's part of the way that the institution works. And I think it's part of the reason that they have the problems that they have, is that there's no heterodox opinion at the Fed. Everybody conforms to a certain viewpoint, and everybody conforms to a certain way. So yeah, I do think it's scripted. But again, if you are a Fed governor or if you're a Fed president, you can call John Williams at the New York Fed or go to his office, or Lael Brainerd's office as vice chairman, or Jay Powell's office, and you can make your case and they will listen to you. They don't have to take your advice, but that's what you get to do as Fed chairman. And I think that Congress knows this too. There has been now, if Lisa Cook, who's been nominated and looks like her nomination is going to fail, she is going to be the 12th Fed governor of the last 10 years that was either suggested by a president or actually nominated. And I'm using, you remember, Steve Moore and Herman Cain were suggested by Trump, but they never got to the nomination point, so they're part of the 12, that never made it to the finish line. And the Fed in the last 8 years is supposed to have 7 governors. I think there's only been less than 1 year in the last 7 that there have had a full staff. Now, why is it that the Fed is never fully staffed? Because everybody knows all you need is the chairman and the vice chairman in the New York Fed, and the rest of them are just hood ornaments, and they're really not there to do much of anything. And we just, that's why you get people on top. What makes it worse is you get some Fed governors like Jeremy Stein, who actually leaves the Fed to go back to Harvard because he doesn't want to lose his tenureship. Tenure is more important at Harvard from him than being a Fed governor. There was another Fed governor, I think it was Randy Kroszner, who left because he was going to write a book. He was going to write an academic textbook. So he left being a Fed governor because writing an academic textbook was more important to him. It's not a very serious job to be a Fed governor. So yeah, there's only 3 people that really set the policy, and this is the consequence of it. Your second question about I riffed too much on that one, but your second question was about whether or not we were going to have a financial accident.
Well,
Sure,
the moment there, like a Hank Paulson moment, and if the migration back to bonds is a safety flight.
Yes, I people have asked me, put the question this way: is there still a Fed put? Yes, the strike price is much lower. How low is the strike price? I don't know, but I'll know when we've reached it. If the stock market keeps going down and going down and going down, and at one point you start to see the bond market rally like crazy because the stock market's down. And by the way, that point was not today, because we were down over 4% on the S&P, and we were pushing 310 at one point on the 10-year yield. So we were going in the opposite direction. But if you see the stock market go down and you see a flight to quality, then that would be the bond market signal to you, okay, now we've done some real damage. And now the Fed's going to have to step in, or somebody's going to have to step in and start doing triage. And therefore, the whole idea of aggressive rate hikes and QT might be called into question. It's time to get into bonds. So as long as you continue to see the market, this is my opinion, as long as you continue to see the market weak and bond yields high, we're not there yet. But when you see the market sell off and you see the bond market catch a huge bid, then it tells you, okay, now we've done the real damage, and now is the time. So that's kind of the way that I would kind of view it at this point.
Yeah. So Jim, if I can interrupt for 1 second, Bobby J, are you still there, Bobby J? I wanted to ask about credit spreads.
I'm here.
Yeah. So so to the point Jim was just making, and Mark was asking the question, you're watching credit like a hawk. You mentioned earlier how this, the smoke detectors got disconnected, whatever. You also pointed out to all the dumb equity guys like us, don't just pay attention to HYG because of the duration component. Could you speak to, and as spreads have started to move out, but could you speak to where credit spreads are right now? Is there any real sign of distress, or it's still early days?
Not at all. I mean, maybe triple C's have widened out, but credit has also been kept tighter with the energy bid. So, we are at very high valuations, projecting very low default rates. We had Marty on here 2 weeks ago, and I think the variables that are going to drive credit spreads wider will be higher 5-year rates, and also industrial production sell-off, but also tightening of bank credit and bank lending, which I think is going to be coming down the road. So I still see credit widening to be a third or fourth quarter event, and just the triggers and the leading indicators for that are just not here yet.
Right, and so like as we've heard, you just explained, the great Michael Howell's been in this room for looking at spreads and the refinancings of corporations. We're not there yet. I mean, there's a long way to go still. So to Jim's point, I mean, we all know there's a Fed call now, not a Fed put, and they're going to break something, but you're not at a point here where it's really causing any distress. I mean, if some stupid stocks on 30 times sales get blown up that Kathy Wood owns, that's not a systemic risk. Before we go, I want to bring Guy Cirandulo in, but before we do that, I just want to play a clip. And Jim, I'd like you to respond to this. Jim and Mark, in particular, and Michael Belkin, if Michael Belkin's still there. This was talked a lot about on Twitter today. Brian Belsky was on, and he's a strategist at BMO, and like I wanted to shoot myself in the head when I heard this. He was talking about how the bond market is not respecting the Fed, and the bond market's all wrong. And it was, and Scott Wapner actually did a fabulous job of challenging him, and it just reflects the mindset of just how screwed up the investment bodies. Mark Newman, did you see that clip by chance? I'm curious. Do you know the clip I'm talking about?
I lost you there for a second. Who are we talking about? Are you talking about my nerd?
No, we're talking about Brian Belsky at BMO or Jim. Did you see?
I didn't hear Brian. No.
Yeah, I'm going to pull the clip up here in a second, but it really is just mind-boggling. And this speaks to regime change, that people are still looking at the investment landscape through the rearview mirror, and they just don't get the joke. And and one thing we haven't talked about, and while I'm trying to find this clip, and Mark and Michael and Jim and anyone on stage who wants to speak to this, or Guy Cirandulo, we haven't talked about Kathy much. I think John Roque or somebody tweeted it out today. She took in $330 million or something like that yesterday or whatever. She's gotten inflows the last few weeks. I mean, here it is. The market's tanking. She's at the epicenter of stuff is getting destroyed, and she's taking money in. Like things that you don't see at a bottom. I mean, Jim, Guy. Maybe Guy. It's a good question for you because I know you're very bearish in technology stocks. So maybe that's a good lead-in for you, Guy, because I know you and I were talking, and you're pretty bearish in some of the tech names. But I look at Kathy Woods taking in money, and I'm like, you got to be kidding me. And it gets worse. I started going through her portfolio again today. I do it every couple of weeks just to say, hey, is there anything close to fair value? I hate to be a fundamental analyst, but forget about the charts. Charts are horrible. But I started saying, like in any universe, could I consider buying some of this rubbish? And the answer is no. So, Guy, maybe you could just speak to, in particular, some of the technology stocks, because I know you got pretty negative views on that.
Hey, George. Great space. I would suggest that you start a space for Japan Twitter space, because I covered Japan when I was at Wellington. I know you covered it when you and I were at Fidelity years ago. So no reason to sleep. Just keep on working. Anyway, kidding aside, the bottom line is, I was looking at PayPal recently, and it reminded me of a study I did when I was at Fidelity back in the 90s, and I left there at 2002. We were studying the progression of the stocks rallying into the 29 peak and the aftermath. I think PayPal is like a poster child for what we saw back then and what we're seeing now. So the bottom line is, if you study the charts back in the late 20s, 29 peak into the 32 lows, many of the stocks, I don't remember the exact number, but it's going to be plus 80%, 90%. After the stocks peaked, they all declined to where the parabola started. So, if you look at a PayPal chart, it's down there. There's many, many other charts that do the same thing. So they basically round tripped where they started going parabolic. So, with that aside, I think, the comments I really wanted to make were going back to my early studies when I started in the business back in '86 with Walter Stone, who you knew in Boston. Again, George and I overlapped at Fidelity in '89 and early '90s, and I worked at George's hedge fund in 05, 06. So the thing that Walter said to me, and again, Walter was a technical analyst, managed a small amount of money, but he did a monthly piece that he sent out to portfolio managers in the Boston area, Bill Diani at Wellington, Ken Heberner, and some of these periodicals I would hand deliver myself. But anyway, the bottom line is I came to work with this guy when he came to Northeastern, where I was the vice president of investment club, and he started drawing these squiggly lines on the chart board, and chalkboard, and I got so excited. I followed him to the train station. I said, "Thank you for coming to speak with us. I want to learn this." And he said, "Well, I can't afford to put you on the payroll." I said, "I work for you for nothing." So, bottom line, I worked for there for 3 years, and then no compensation, cup of coffee in the morning, lunch now and then, book for Christmas. That opened the doors to Fidelity, where I overlap with George, and then the rest is history. So the things that jump out to me, George, of what's happening now with what Walter taught me back then in the 80s, that the market is a one-act play. The storyline is the same. The price action we see in securities are more or less the same. The thing that changes is the actors in the play, because human emotion really takes over when you have these bear market rallies. And I brought up a chart. I'll post it tomorrow on my Twitter space. And the thing that really stuck out to me now with what Walter said to me back then is that, when the 1929 market crash in October, people lost a lot of money. We're down 44%, but that's not where people lost most of their money. Most of the money was lost 3 months later after the secondary peak, when we rallied 48, 49%, because these bear market rallies sucker people in a big, big way. So after that 48% rally, we declined 27%, then rallied 16%, down 35, up 31, down 34, up 29, down 44, up 34, down 37, up 23, then down 53, which was a total of 92% from the original peak. So the point I'm making is that these bear market rallies sucker people in. They think that everything is over. They make you think everything is over. And we see that with the boob heads of the CNBCs of the world. Things are fine, and whatever fundamental valuation you want to put on stocks and this and that. It doesn't make sense unless you have a good structure of a bottom, secondary, higher lows in place, and other structure in place to say that there's a low put in. All that we are getting are pivot lows that are relief rallies to these secondary rallies that are pretty sharp, and they sucker people in, and we're going lower. So that we saw the same thing back in 2007 and 8. Off of the initial decline in 2007, down 20%, up 14. I could go on, but the bottom line is, from what I'm seeing, the topping patterns in Amazon's, the Googles, the S&P, it's such that I'm still looking for, from peak to trough, 30 to 35% in the major averages. I didn't want to post the Amazon chart and Google charts I sent out to clients recently. I'll do that tomorrow because it's enough time that I'll pass it on to other people. But even on Amazon, there's another 20% downside from the money flow unit work that I do, which you're familiar with, George, where I'll feel comfortable to say that potentially we have a low coming in. But man, these things are, flip the charts upside down. If you say for one moment that these are buys, then you know that these are sells. So we still have more problems ahead of us.
I appreciate that. That's great. So I'm going to play a 2-minute clip. It's from Scott Wapner and CNBC today. It's Brian Belsky, who's a well-known strategist from BMO. And I just wanted to shoot myself in the head when I listened to this. This is complete insanity. So this is for Jim Bianco, Bobby J, Mark Newman specifically. I mean, this just takes the cake. So just bear with me. This is just a 2-minute clip. Please listen. And the money line is, the bond market is being disrespectful to the Fed. Listen to this nonsense.
Humbling as the markets can be for everybody. Not enough to get you off of 5,300, though, on the S&P 500, right? Why? Simple. Why?
Simple. Why? Well, you saw that yesterday's reaction and the binary nature of markets yesterday and today. I still think we can see a binary event that'll shock people to the upside, but it's all about price. We need to kind of flush out some of this every other day negativity, positivity. And like I said on Monday, we could see a positive result to the war. We could see a positive result to inflation. Mr. Powell said himself, we're not going to use 1 month. We're going to see a couple of months. The way that the Fed has operated, he's been very clear, as Leisman said, 50, 50, 50. And then we don't have a meeting until September. between July and September, we could see a pretty decent fall off in inflation, which other Fed members are actually saying. And so the bond market's telling you that the Fed is wrong. And don't fight the Fed. And I think the bond market's actually being disrespectful to the Fed. The Fed's the smartest person in the room.
Disrespectful.
I'm going to stick with the Fed.
Disrespectful?
Yeah.
How are they the smartest people in the room? I mean, inflation was screaming in their face, and they ignored it.
Well,
how are they the smartest people in the room?
Well, I don't agree. They're the smartest people in the room because think about what they did in March of 2020 for this country and for the rest of the world in terms of the liquidity, Scott.
They did what anybody would have done.
Number two, no, we didn't do it before in 2008. We made mistakes in 2000. We made mistakes in 1994.
We
made
learned
mistakes
from
in
those mistakes, right? They're smart enough to have learned from the mistakes, but they did what anybody would have done.
The bond market is misjudging the Fed. The bond market is I think the bond market's ahead of its skis here. I really do. And if you listen to other very smart fixed income investors, they're telling you that the fixed income market is massively oversold, Scott. And so if the Fed came out and said that the neutrality rate is somewhere between 2% and 3%, we're already there in the 10-year Treasury. And what if the market is not thinking about anything I said in the second half? What if inflation rolls over? And if inflation rolls over, this market is going to rip to the upside.
So
the move lower in technology.
Like, I don't know where to begin with that. I mean, if you actually watch the video, you can see he's a bit out of sorts. I suspect he's on the wrong side of the market because he looks rather animated. But saying the market, I mean, when he was talking, we've all been there. You own a stock that goes the wrong way, and you say, "Oh, the market's wrong." Yeah, okay. But I mean, this is a major strategist for BMO. Like, seriously? So I don't know. Newman, Bianco, Bobby J, Guy, anyone want to take that?
Well, I know he's on the wrong side.
Get him as a guest, George.
He's on the wrong side, George. He's been bullish, and that's his MO.
I mean, and the problem is, and Jim, I don't know if you're still there or Mark, we look at the flows. I mean, you had $1 trillion, and I know Michael Green's in the room, but, the passive bid, the flows, all the money that piled in, and whether the $1 trillion number is correct or not doesn't matter. As Walter Deemer always says, the public buys the most at the top. And, they've only just started to sell. We saw a couple weeks. And if the dam breaks, look out. As if we didn't have enough to worry about already. I don't know. Does anyone have any thoughts about flows and positioning?
I was just going to make a quick comment about what Belsky said. If
you
listen to him, well, what if the war ends? What if inflation goes away? Well, of course, if all the bad things in the world disappear, then yes, then the market can go much higher. But the question is, why does he think that the war will end? And why does he think inflation will go away? Because the Fed said it will. And, Wapner was right. This is the same organization that got it about as wrong as you possibly can last year. And as I said earlier, the policy mistake was last year. This is the consequence to the policy mistake. So, yeah, if he wants to go on and say all the bad things in the world are going to go away, okay, then we will rally. But I don't know why he thinks that all the bad things in the world are going to go away and why he can be so precise that something magic is going to happen in the month of August. Because he said, between the July meeting and the September meeting, what if inflation goes down a lot? I don't know what magic thing's going to happen in August that's going to cause inflation to go down. I mean, George, it's kind of like, one of your analysts saying, well, what if the company's earnings just double? Well, okay, that is cheap if it just doubles, but just because you said it doesn't mean it's going to happen.
I mean, do you remember how Byron always has those 10 surprises, which have like a 1 in a million chance of occurring? Yeah, well, it could happen. You're right. Like, the Chicago Cubs, your beloved Cubs, they could win the World Series. They actually did it one year, okay? But you're like, pigs can fly. Yeah, okay. It's unreal. All right, we're kind of moving on here around 2.5 hours. I see we have two speakers who haven't asked questions yet. We're going to go to Queen, and then we're going to go to Maggers, and I think we're going to call it a night. So, Queen, welcome. What's up?
Thank you so much. Thanks for hosting this space, and for letting me jump up and ask some questions. I was a banker, and before I became a professional athlete. And right now I'm actually helping to co-host / host OSINT spaces regarding Russia's invasion of Ukraine. So we talk a lot of, about the tactical daily situation in Ukraine, but also the wider geopolitical issues as it relates to gas, oil, energy prices. So I was hoping, if you don't mind, I have a few questions, well, for the whole panel, and especially for Mr. Alhaji regarding oil and gas, if it's okay. I'd just love to touch on that.
Queen, I would ask you one question. It's late. I don't want to open up Pandora's box. If you have one energy question for Dr. Alhaji, that's great. But I don't want to make this. I don't want to go off on a. I don't want this to go to 2 a.m. discussing energy. So if you have one question, Dr. Alhaji, I'll allow it. Otherwise, we'll try to keep it tight, please.
Sure, no worries. So I just wanted to ask Dr. Haji if he sees any potential for some of the Gulf states to increase their production of oil and gas to kind of this year.
Generally speaking, they decided from in the OPEC meeting basically to increase it. I think the Saudis and the Emiratis and the Kuwaitis and some from Iraq, we are going to see some increase in production regardless, as planned. Not to compensate for the Russian oil, this is just as planned. In terms of gas, there is no gas, period. Qatar does not have it. We don't have any gas in the world to replace the Russian gas. We are going to see some reshuffling of this. And we are seeing a trend where if you look at Qatar sells its LNG in the as long-term contracts. So what the Biden administration did basically is they convinced the Qataris and the Japanese, and they are trying to work with others because the contracts have clauses does not allow the buyer to resell. So the Biden administration convinced the Qataris and the Japanese to relax this condition in the contracts. So those who have extra, just like Japan, can reroute the shipments to Europe. So there is some extra coming, but that extra should have been going to storage to prepare for the next season. So it's kind of like just a Band-Aid for now. There is, generally speaking, there is no replacement, period. No replacement if we lose all the oil, all the Russian oil, or all the Russian gas. I want to clarify one point here because it seems the media was not able to clarify it very well. If you look at the Sakhalin development, that's in the east, where we have oil and gas. The development is in northeast Russia, and the sea there is frozen most of the time. And therefore, the oil tankers are special oil tankers that can break the ice and go through the ice. And because no one is interested in that, all the investment came from Russia, from Russian companies, and those are Russian-owned tankers. And because they are Russian oil tankers, the sanctions hit them really hard. So they cannot take the oil from Sakhalin to South Korea, where they can load them on regular tankers and ship them around the world. So we are seeing a major issue in terms of supplies coming out of the east, which was the last thing we thought about at that time. There is no replacement for that either. So we have a serious problem. And please, George, allow me to mention this. For the new followers who are following me, I put a lot of stuff in Arabic. And Twitter has a translation function. So please, if you see in Arabic, some of the stuff is exclusive. So just push that translate button and you get the English or whatever language you want to use or you are using, you can benefit from that. And that translation function in Twitter is just amazing. The final point I would like to mention, since a lot of people are interested in real estate, there is something about real estate and oil that some people do not know about. If we end up with a recession, one of the best investments is to invest in real estate in oil towns. I'm talking about West Texas. I'm talking about North Dakota, simply because of that energy crisis I'm talking about, because of the continuous increase in oil prices while everything is going down. They are going to be boom towns, and with boom towns, people focus on oil, but they forget about real estate, because we need housing for the staff, for the engineers, for the workers, for CEOs, and for the management and everything else. And therefore, that, just like in the past, it would be great investment. Back to you, George.
Hey,
Thank you.
George, real quick.
Well, hold
George,
on. Three aces.
yep.
Three aces. Hold on. Thank you, Dr. Alhaji. Appreciate it. Three aces. I think you wanted to say something about where we are with the charities, if I'm mistaken.
Yeah. Sorry, I didn't mean to interrupt you. And thank you, Doctor. Always just magnificent. I just wanted to say thank you to everybody. We raised over $10,000 here on one Spaces. We got about 35, 40 people. A couple of very generous donations. I don't want to mention any names in case those people want to be kept to themselves. But just wanted to say thank you. That's probably about 2,500 or so meals. We fed 2,500 people here on this Spaces tonight alone.
Just three aces to add.
It's awesome.
For everyone in the room, we are around $16,000 away from triggering the $50,000 match. There are, I think, 1,800. There were 1,800 people in this room. Seems to me $16,000. If we're all reaching out in our pockets a little bit, that'll Alexander from Switzerland. He has a $50,000 pledge that he's put up. So we've raised 34 of the necessary 50. If we can raise 16,000 more, we'll get 50. So basically, if you put up $1 right now, it's going to be tripled because that's the matching pledge that's there. So I urge everyone to give as generous as they possibly can. This is just, and I have to say, and I tweeted this out, this is the greatest room ever in the history of Twitter Spaces, period. I defy anyone to show me a room that has the intellectual firepower of this room. I keep saying, and I mean it, we have the best speakers, we have the best content, we have the best moderation, and we have the smartest audience. This room tonight has totally blown the top off of everything. And aside from everyone learning so much, I mean, I'm just blown away. I've never been to a conference where you can hear all this from so many smart guys. We've also raising money for charity. So if we can raise 16,000 more tonight, we will trigger a $50,000 match. So I ask everyone to please, please, please give generously. All right, a few more questions. I think we're going to kind of try to wind this thing down. I don't know, three aces. You're not on West Coast time anymore, so I think maybe you want to go to sleep as well. But let's go to Maggers. Maggers, welcome. What's on your mind, please?
Yeah, thanks, George. I would definitely concur. Since you started doing all this, the ability to listen to a lot of smart people in the industry and get some different opinions has been certainly invaluable. My question was, I definitely feel that there's a consensus that the Fed is, amongst us certainly, that the Fed is going to basically hike until something breaks, and there's usually in every bear market, there's some, maybe unforeseen systemic risk in some asset that perhaps people didn't necessarily take fully into account. And, I'm concerned that the crypto market might well be one of those areas. How quickly could that space unravel, as that's clearly has a lot of hot money and a lot of leverage in it? Could be some unforeseen risks there, and how do you guys feel about how that may play into things?
The Maggers, I'm going to be short on that question just because my views on crypto are well known. I think the 800-pound gorilla in the room is the whole Tether scam. The regulators are asleep at the wheel. Whether they're on the take, or they don't want to be seen to upset the apple cart. Don't really know, but I think the whole crypto. It's a topic for another room. The reason I like talking about crypto is people have very strong views about it. The protagonists, the bulls, they're not. You can't say anything to dissuade them. Equally, the bears, you can't say anything to dissuade them. But thought experiment. What would crypto look like? What would Bitcoin look like if we hadn't been in the zero gravity world of 0% interest rates? And so as we normalize, I think, and the gravitational pull starts to reassert itself, I think this thing comes crashing down. Essentially, all the assets that are most hypersensitive to hyper liquidity, be it stocks on 50 times sales, or crazy SPAC stocks, or Shamath, or just go down the list. Those are the things that have gotten shot the most, and crypto's in that pile. So I'm passionately bearish on crypto. My own view, amateur chartist here, but I think Bitcoin is going back to 11,000, and I say that going back because that's where the rally started from in the fall of 2020, and essentially there's been the counterfeiting of 70 billion worth of Tether, plus untold billions of other stable coins that have been used to inflate the entire crypto landscape. So, run, don't walk as fast as you can away from crypto. I've been short Coinbase. I think it's a great short. So no, I hate crypto. Thanks for the question. Let's go to Joseph Fahmy, please. Joseph, you have a question?
Yeah, thanks for the opportunity, George. Much respect. Love the spaces. Love Jim Bianco's work, and I really appreciate it. Also, you said this is a great collection of minds, so I'm here to kind of bring the standard down in the room, if that's okay. But anyway, just messing around. But I don't want to talk about the macro side, more on the psychology side, where it just amazes me because I talk to a lot of retail people, and I'm actually amazed at the complacency based on like sentiment measures and what I see. And what I mean by that is I feel that the market's a master manipulator, meaning it just convinces you of one way over and over and over and over. And when you're finally convinced, it changes character. And that way that it's convinced people, especially a lot of the retail people, is that it's just convinced you for years, buy the dip, shut up and buy the dip. We're entitled to new highs like every 2 months, every 2 weeks. And the character is totally changed. And what's amazing in the psychology is that there are people who are holding on to, and I'm not going to pick on Cathie Wood, but the Cathie Wood stocks that are down 50 to 80%. And I talk to them, they are never selling. They are brainwashed. I mean, you see the numbers, she's having all these drawdowns and still getting inflows. I have a 5% drawdown. My clients, like some of them want my head cut off. Like, I just can't believe she's down this much and people are pouring in. But I think it speaks to the psychology of, it's scary. It's not just retail, but I had the same reaction as you to Brian Belsky's thing that I heard today, and to Cathie Wood. Like, it's not only retail, it's professionals that seem to be brainwashed. And, I'm not like a mega bear or anything like that. I'm just realistic. We're going through a period where they're taking liquidity out of the system and you don't want to fight the Fed. And I'm just amazed at not just the retail people who are literally never, ever selling some of these stocks that still have more downside in my view, but I'm shocked at the professionals that are just not seeing this at all.
Yeah, it's a really interesting point you raised. We had a terrific space yesterday with Peter Atwater, professor of behavioral finance from William & Mary. And he was talking about this phenomenon and basically, why do people do stupid things? Why do they buy crypto? Why do they buy AMC? Why do they buy Beanie Babies, et cetera, et cetera, et cetera? And I forget the line from Mark Twain. It's harder to convince somebody. It's harder to. Someone will. I'm getting tired, but basically the idea is it's almost impossible to convince somebody that they're wrong of something. And so you're right. They're hanging on. There's this. Peter was talking about the change in time preference, that when people get sort of detached, they'll start to like really extrapolate out into the future, and they wind up doing really wacko things. I'm not doing his spiel justice, but if you go on my feed, you'll see the replay. We're now on YouTube and Apple and Spotify. But if you want to know why do people do crazy things, It was a fascinating discussion. Peter is the best, and so I totally agree with you, Joseph. And this type of behavior. These are things you don't see at a bottom, and the market will not bottom until these guys are puking. And so we got a long way to go. And then just beyond the Kathy stocks, Joseph. I mean, you tell me you're RIA, or you have a client, you're down 5%, people want to kill you. I mean, let me ask you a question. Forget about the Kathy stocks. What about just the idea that all the financial advisors, Fidelity's, I used to work there, Vanguard, whatever, it's always stocks for the long term. Jeremy Siegel will call your office. You can't sell because if you sell, then you got to figure out when to get back in. If you sell, you got taxes, blah, 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 blah. So basically, it's like boiling the frog. They just sit there. And one thing we didn't talk about, and I wish we had, I forgot to mention this about all the technicians, but someone did bring it up a little bit. The idea that, whether the market keeps going down, doesn't, who knows? I think it does. But more importantly, the idea of time. In other words, when this bear market is over, and I think it's got a long way to go. Michael Kanchowitz thinks it could be a year or whatever. The idea of time, the sort of drip, 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 water torture market, grind it out. I joined Fidelity in 1981, coming off the decade of the 70s. Fidelity had actually lost money for a few years in the 70s. People would come into work expecting the market to go down every day. The psychology just is completely different. And so I guess the question I want to ask, I'm sorry to go on a ramble here, but the mindset that's evolved. I mean, this is a 40-year bull market. It's not going to go quietly in the night. They're not going to give up the dream that quickly. So, there's got to be decline, rally back up, failed lower new high, yada, 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 yada. So what is it going to take in your view? Is it just a question of time? Because I'm fearful that even if the decline, when this thing bottoms out, it's not going to come back because that's whole liquidity-driven, Momo up and to the right, just printing money like crazy, Marshallian K going through the roof. Like, those days are over. Like, that is not coming back in our lifetimes, in my opinion. So what does it take, speaking to psychology, in your view, what's it going to take for these people to change their minds? You look at the, I'm ranting now, but you look at, for instance, the flows. Last year, a record amount of equities bought, whatever, this is $1 trillion or whatnot, all right? Those guys have hardly begun to sell. You've seen 2 weeks of outflows. So do you think we're anywhere close to people maybe giving up the ghost? And what's your outlook towards sentiment and how the investor class is likely to change their behavior and their attitude? Sorry to rant, but
No, I love it. I love listening to this.
I mean, take a shot at any part of that you want.
Yeah, no, there's like a million things running through my mind. I'll try to make it quick. I think time kills more people than price because most people can't make decisions. So if you have 2020, when we dropped whatever it was, 32% and 42 on the Russell, whatever, and then we just snapped right back. By the time people realize what's going on and we started to snap right back, in other words, a 30 or 40% decline in a month or two that starts to come right back is not too bad because that by the time you decide, it comes right back. But a sideways market, for example, that didn't correct more than 10% for a year, that would torture people more because we live in an incredibly impatient world, and people, like I said, it's a generation of people almost feeling like they're entitled to new highs all the time. So I think time kills more people than price. Now, to your question of what would it take, I don't know. I like to look like as one of my favorite sentiment indicators is the equity only put to call ratio because the overall is a lot of hedging where the equity is very directional. And I'm actually shocked that on every attempted rally, there's just no signs of fear, nowhere close to extremes. It's been a little bit elevated, but nowhere close to extremes. And the same thing happened in the fall of 2018, where we started to drop, no put buying whatsoever. And then we started to drop some more. And then when Powell came out in that mid-December of 2018 meeting, said we're still going to raise 2 or 3 more times and we're going to reduce the balance sheet, it wasn't until that final puke into like right before Christmas of 2018 that equity put to call ratio spiked above 1. So it's not that that's a magical indicator, but that's at least a sign of some fear escalating, and especially on the retail side. And right now, to answer your question, I think we need to see that, but I don't think we're anywhere close to that. We have one little bounce, and everybody, it's like Pavlov's dogs, where I understand they're conditioned. Every single time we have a rally, everyone's like, hey, is this the low? Is this the low? Is this the low? It's like having little kids in the car. Are we there yet? Are we there yet? It's just nonstop. And that mentality, to your point, I don't know when, but it's going to take time to change. And I don't know how long it's going to take. I think a slow grind into the summer, could do it. Time could really hurt people. But right now, there's still a lot of people. I hate to use the word brainwashed. There's still a lot of people brainwashed.
Joseph, you know what my fear is? Not fear, but I think listen, I don't want to yell crowd. I don't want to yell fire in a crowded theaters. I think there's still 1,500 people on this call. However, and trying to call the end of the world is always a stupid idea. So I don't want to be quoted as saying that. However, I'll remind everyone, and you know this, crashes only occur in weak markets from quote unquote oversold conditions. Crashes only occur in weak markets. And my fear is, and Michael Green talks a lot about Michael's market structure and so on and so forth. You had this price insensitive buying. There was no price discovery, all index passive flows, yada, yada, yada. All the money that came in last year is all now trapped. All that, okay? Some of that, of course, it wasn't passive. It was everyone spending their stimulus checks and God knows what. But all that money's underwater. And I'm wondering if all the elephants try to get out of the phone booth at the same time, that the entire market could get Netflixed.
It's possible, or it could be a slow grind until then. I don't know. I mean, so many people I've talked to just get the crash out of the way. I'm like, well, number one, be careful what you wish for, and number two, what's even more painful is a zigzag back and forth for the summer.
100%. Because, to your point, let me illustrate your point to the audience a different way. If I gave you two choices, door number one, the market's going to fall 25%. But then we'll go back to what we were doing before. You'd be like, oh, shit, we're around 25%? Like, really? Door number two, great news, Joseph. The market's only going to go down 5% or 10%. Oh, I like that. That's a good one. I'll take that one. There's one catch. 5 years from now, it's going to be the same price as it is now. That will drive everybody nuts. And one of the things that drives me insane, having done this for 40 years, these corrections, it's always buy the dip. They're short and they're sweet. I mean, 2020 wasn't a bear market. That was like a mistake in my view. We had this COVID thing. If you just put your finger put your thumb over March of 2020 and just wipe that out, all right? There wasn't enough time to really inflict pain upon people. It happened, and then it was fixed. Fed fixed it. And so everyone, the company could have bad earnings or something horrible could happen to a given stock. It was like, oh, everybody knows that. Enron's going bankrupt, sell the stock. No, everybody knows that. I mean, it's like, let's just be done with it and move on. But talking about time is what grinds people down. And I strongly believe that that's what we're looking at post whatever this market downturn turns out to be, so that it's not just what will returns be over the next year or two if we do get a big bad bear market. I just think prospectively, given that we've been in this sort of the central bankers just kept the champagne flowing, kept spiking the punch bowl every step of the way. Things relentlessly kept moving from the lower left to the upper right. That game is over. That's not normal. That is not normal. Unfortunately, large swaths of the investor class, that's all they know post-great financial crisis.
Well, let me ask you a quick question. I don't mean to interrupt, but let's say the Fed gets to the point where it breaks and then they pause or stop or whatever. They get to whatever their target is, let's say 2%, 2.25% Fed funds, and then they pause and stop. I'm not saying it'll return to normal, but don't you think some sort of a uptrend would resume from there?
Yeah, maybe. But, as Teddy Kennedy famously once said, we'll drive off that bridge when we come to it. It's hard enough trying to figure out what's going on right there. But, if inflation, so let's go to the Bianco world where, inflation comes down, but it's still kind of like the Fed would give their left arm if inflation got down to 4%. I'm just, okay, how it's going to get there, I don't know. But let's just say it did, wave a magic wand. I think that's their forecast from the end of this year into next year, whatever it is. I think it's end of this year. I don't know how they get there. But let's assume that happened. They said, mission accomplished. We're going to run the economy hot. I don't think that gives you buoyant monetary conditions. I mean, this Marshallian K, the difference between money supply growth and the economy, that went out to record wides, unprecedented. We printed all this freaking money, and we've been doing it for years. That game is over. So, yeah, I agree it'll stop prices from going down, but I don't think you're ever going to see in the next few years liquidity conditions, expand so much to cause the bubble, the everything bubble that we had. That we had. I mean, Michael Howell's been in these rooms. He's talked a lot about this. It's liquidity. It's always been about liquidity. It's about liquidity. It always will be about liquidity. So I don't know. I just think you go back. I remember in the late '90s, in the run up to Y2K in 2000, the S&P had never gone up 20% a year. I think I got my numbers straight. I'm getting kind of tired, but it never gone up 20% a year for 3 consecutive years in entire history. It did it for 5 consecutive years, and then we had the lost decade. And I think there's a little bit of that in the future for us. So anyway, really appreciate your insights. All right,
Thank you. Appreciate it.
Yeah, let's move on here. Hold on. We've got.
Hey, George, can I ask you a question about something you just said?
Yeah, go for
it. About the market getting Netflixed. Just quick observation and a quick question. Yesterday, when Powell said 75 is off the table, S&P futures 30 handles next trade is basically what it was. Now, what that says is that are there any human beings left in this market, or is this all computers banging on computers? And is that how you wind up getting this market Netflixed? And what we saw yesterday and what we saw today, wasn't this just computers banging on computers? How much of that do you subscribe to as opposed to actual human decisions that went into what we see in these markets right now?
It's a great point, Jim. I mean, whether it's the computers and or it's some big institutions, they just want to move stuff. Signing computers, they want to move. And as you pointed out, liquidity just sucks. I mean, so, size wants to go to buy, limit up. Size wants to go to sell, limit down. So I think what underlines both of those scenarios is liquidity in the market just ain't what it used to be. So on a related question, and I'm going to throw it back to you, napkin math, back of the envelope, and now we're going to go back to Fed policy and liquidity. It's been observed by some smart cookies that each 100 billion is worth about 40 S&P points. At least that's what it was on the way up. And the thought is on the way down, it'll be that or maybe even more, just because market structure is less liquid. It could be even more problematic. So if the Fed is serious, or they claim they want to reduce the balance sheet by $3 trillion over the next 2-3 years, 30 times 40, 30 times 50, whatever, you're talking about 1,200, 1,500 S&P points. I mean, we'll never get there. Something will break before then, but you've basically condemned the stock market to die. I mean, how would you respond to that, Jim?
I think that there's something to be said about that. People sometimes fall into the trap when you look at the amount of liquidity that's put in the market. Look at how much the market's gone up since 2009 when they started QE. Well, it would have gone up some organically anyway. But if you were to take 1,200 points out of this S&P. Now, remember, we were 4,800 at the high. So we've almost got 500 of those points out already. So we're approaching that halfway point is where we are. So that makes sense. And I also do believe when you said the thing that will really kill everybody is time, too, not so much price. Because remember that with the aging baby boomers, the devastating thing you could tell somebody who's 65 and they just retired is, your portfolio is not going to do anything for 10 years. You tell somebody who's 35 that, okay, fine. But if you tell somebody who's 65 that's the thing that scares them more than anything else. So I definitely think it's time. And by the way, one other quick thing about what Powell said yesterday. On the upside, QE, it was believed that they were throwing out numbers like every somewhere between $200 and $400 billion was the equivalent of a rate cut. So when you increased the balance sheet by 200 to 400, it was the equivalent of one 25 basis point rate cut. Yesterday, Powell said, $1 trillion reduction in the balance sheet is one rate cut. So all of a sudden, one rate hike, excuse me. So all of a sudden, he's trying to say that QE is 5 times more powerful than QT. So I think he's, going to be for a rude awakening, that he's going to find out that this stuff is a little bit more symmetrical than he thinks when he starts pulling that money out of the balance sheet, and that it's going to have a bigger impact than what he thinks it's going to have, and that's why that 1,200 point thing makes a lot of sense.
Thanks.
You know,
Hey, Abe, good to see you. What's up, Abe?
Hey guys, phenomenal as ever. I was listening to Hugh Henry yesterday, and I think perhaps many of you were listening as well. And I can't keep wondering that we're essentially in a bit of a circular kind of movement, whereby the Fed moves to tighten and obviously allow some of their assets to run off. But the question I wonder is, okay, so that continues to happen. We don't know where the hell the Powell put is. At some point, it'll arrive, and we'll continue to reinflate this crazy market that we have. But at the same time, I continue to wonder, where the hell is the exit here? Because if the one thing that I've noticed since 2008, and I was smack dab in the middle of it in structured finance and securitization at the time, and I keep wondering, we've never had a cycle that has allowed itself to actually rid itself of any excess. And we saw that in 2008, and we certainly don't seem to have that same kind of appetite to allow the market to actually to rid itself of any excess. And so the question I ask is, are we in some sort of a perpetual loop in this process? I mean, where the hell is the exit? Because I just don't see it. I see it sort of like okay, we allow the market to deflate. We get to a Powell put. We start to reinflate it. We have inflation in the backdrop. We don't know whether it's sustained or temporary or whatever. And here we go again. I mean, in all of this, do we ever go back to the notion of organic growth, or are we always going to be living on sort of assisted living through the Fed? Thank you.
It's a great question, Abe. The folks at GavCal have done a lot of great work about this. They speak about the excessive financialization of the economy. I think that's where you're going with this. And when you have such low rates, cap rates fall so much, all you're doing is bringing forward returns. You're stealing from the future. And it just incents financial actors to lever up, and there's more M&A and takeovers, and not really invest. And so I actually think, okay, now it's late, but there's still 1,500 people here, so they're going to come after me. I actually think raising interest rates is a good thing for the economy. We've had too much bullshit investments in goddamn food delivery apps and dating services and all this useless rubbish, and too much speculation, M&A, which is value destroying. Investment bankers can make all their fees. All this nonsense about pushing up asset prices like it's going to help the economy, I think it's a total scam. I really do. I mean, people estimate the wealth effect at 2% or whatever the hell it is. All right. I think the whole thing is a giant con job. I think and you know something? If rates go up a lot and some bullshit companies go bust that shouldn't exist in the first place, we're basically Japan on steroids, that's a good thing. It's not a bad thing. It's a good thing. Creative destruction, get on with it. All right. So the healthy remaining companies can do well. This is all fucking bullshit, so that the guys who own the assets can make more money. And you know something? The people aren't stupid. They're figuring this con out. So, my argument has been that I think rates can go up a lot more than people imagine before something breaks. Something will break. John Roque put out a great chart the other day, and Jim Bianco forwarded it around as well. It showed how we get these cycles, every few years. Rates go up to something breaks, and then they go down. Well, funny things happening now. Rates have gone up. If you look at that trend line, it's broken. Rates have gone up and nothing is broken so far. Reason is the debt accumulation this time is not on the private sector balance sheet. It's in the public sector balance sheet. It's the fucking government that's borrowed all the goddamn money. All right. Yeah, their interest rates are going up. That's why government bond yields are going up, and they can continue to go up. All right. But you look at consumers. You look at the debt service ratio. I forget it's the income to interest obligations. That thing's like, I don't say it's record lows, but it's pretty damn healthy. Corporations pretty damn healthy. Bobby J, call your office. Look at spreads. So the point of it is, there was listen. I was having this conversation 2 months ago when the 10-year was 170. We're at 305 now. Nothing's broken. And I think the trick is going to be rates can go to 3.5, 4, and something. Yeah, housing's going to slow down. Yeah, we'll get a recession. I get that. But the idea that something's going to break, like going to have big corporate blowups or individual bankruptcies, hell no. Hell no. What's happened is we've kept interest rates so artificially depressed for so long. It's resulted in a huge misallocation of capital. I know it took 3 hours for me to get hot. Huge misallocation of capital. It's like you keep the beach ball beneath the surface. You finally let go, and what happens? It floats up to the top. That's what's happening to interest rates. And so, and that speaks to the type of market we'll have in the future as well, because to your point, Abe, we're talking about real companies and cash flows and earnings and multiples, and we're not chasing goddamn narratives and Kathy Wood and all this rubbish. We'll go back to a real market. There's been no price discovery. And this also plays into Peter Atwater's room yesterday, talking about change in time preference. And so, no, I think you asked an excellent question. And I think the way forward is destroying all this garbage. Be done with it. Do we really care if DoorDash goes bankrupt? Like, seriously? The thing doesn't scale. It can't make money. DraftKings, even though they're at 1,000,000%, you go down Kathy's portfolio, every single one of these is the same. Tesla. That company cumulatively has lost billions and billions of dollars, not to mention that I think 15 or 20 billion, I haven't done the exercise recently, of taxpayers' money that they've cost. Like, what's wrong with our system? Enough. This has to stop. I'm on a rant. This has to stop. 3/8 to stop me before I go over the edge. 3/8.
No, I just wanted to point something out, George. I mean, if we were all sitting here in 2019 before COVID, and we said, there was going to be $9 trillion of, fiscal and, monetary policy put into the economy in 1 year, and the first quarter in which the Fed raised rates from basically zero by 25 basis points, we'd see a negative GDP print, and every long duration stock on the planet's down 40 to 70 to 80%. I mean, you wouldn't. I mean, I wouldn't have believed that. And here we are now, right? Talking about the Fed and the Fed this and the Fed that, and not because we're talking about this. That's what the CNBC world is talking about. What can they possibly do? Going to this concept of do what they're doing until it breaks. If it breaks like that, which I'm fairly certain we're very close to an event of some kind, forced selling event, margin event, whatever, what can they possibly do? Look at what they did and look at where it's gotten us. What could they possibly do?
3/8 is to your point, okay? They create this huge speculative mania. Just want to be tulip bulbs in Amsterdam, all right? And the price of tulip bulbs gone to the moon. It's like, oh, well, we can't normalize rates now because the price of tulip bulbs may come down. Are you fucking kidding me? They created the whole goddamn problem. The answer to this problem does not lie in doing more of the same thing which created the problem in the first place. This has to stop. It will stop. Because you know why? Mr. Market will stop it. Mr. Market is stopping it. And you know what? Maybe, just maybe, we'll start drilling a hole. Dr. Alhaji, call your office. Maybe, just maybe, we'll start drilling more holes in the ground because we need it for productive means. We'll start building more capacity to produce our own crap instead of buying it from China. That's the answer. It's the over-financialization, hyper-financialization of the economy that's caused this fucking problem. It has to stop. But the days The Davos crowd and Goldman Sachs, okay, are hanging on. Well, their number's up. I'm probably going to have my friends who work with me edit out some of this stuff, but that's what I really think. Directors, you want to say something? I see your hands up. Director, the floor is yours. Unmute yourself.
Hey, thanks. I assume most people think I'm a bot because I don't have that many followers, but very good conversation. My question's really on how the Fed's going to get out of this.
They're not.
Well, I think if, we had interest rate move from 3% to 6% basically on 30-year mortgages at, a 700, call it 50 FICO score. That happened overnight. So we doubled the interest rate. Bond goes down 40%. Who's taking the losses? And I think it was 3 aces earlier. It was like, oh, nobody was prepared for this. Like, oh, no one could have predicted this. And so if I call a bond desk or a interest rate, if I called for an interest rate swap, I don't know, call it a year ago, I said, oh, I want to hedge it like 6% or something. They'd say, you're crazy, I think. Maybe I'm off. But so, and when I look at certain filings for companies, I see them hedging in the 75 basis point range, not in the 3% range. So it gives me an indication that there's unmitigated exposure. Basically, we got like $10 trillion of mortgages sitting out there that have been issued at sub 3%, like 0 to 3%. All of a sudden, we got rate shocked, and I want to know who's taking the losses. And I just wanted to answer that question.
Bobby J, you there? This is in your wheelhouse. We're talking credit here and mortgages. I don't know if he's still there. Or Jim, I don't know if you're there. I'm too tired to answer this question. We're going to do a couple more questions. I'm sorry I'm not going to answer your question. I'm kind of starting to lose it here. Let's go to Stan and then Charlie. And I see there's a couple folks out there who have requested to come up to speak. If I don't know you, I've sent you a DM. Please tell me your question. I'm trying to limit the number of questions here. So Stan and then Charlie. Hey, Stan, long time. What's up? Please unmute yourself.
Hey, George. Thanks for having this room. Real quick on the question for that director had. Most of the originators, they hedge themselves when someone wants to lock something in. So they short the 10-year or something equivalent. So they've hedged themselves. They're protecting themselves, and they run dynamic hedging as well if they're bigger houses.
So what we're seeing right now is not duration hedging.
You asked about how the originators protect themselves. I can't speak to all the dynamics in the market. That's way beyond my area of expertise. But George, I did want to I compliment you on your frustrations with what happens with many of these startups. Someone that's invested in startups and looked at thousands of startups, I want to say that part of the problem we have is not necessarily located with the Fed, but the regulatory framework of how these IPOs happen. In particular, the fact that they can go out with a small float that then enables certain players to push those up. And then with the advent of weekly options to further move those up farther, it really should be cleaned up with something like what Bill Gurley has suggested, that everybody's forced to do a direct listing where the insiders can and are forced to unload their shares right away, which would cause real price discovery instead of these things where there's a lockup for 180 days, which drives the price up. So then as soon as they unlock, the insiders can hedge themselves and dump it on the public, which we kind of saw. So I view that as a regulatory mismatch that the Goldman Sachs of the world and the VCs are very cognizant of. So that problem needs to be fixed elsewhere. But I do think that if you look at the U.S., and we do have a lot of great startups, the Intels of the world did start off really small. I'm not going to say that every startup is worth being around, and there's definitely a survivorship bias where the bad ones go away and we don't hear about them 10 years later, but the good ones become bigger and better. So, but that creative destruction makes the U.S. unique, and we bring lots of smart minds here. So having that process still open is helpful. So I'm a proponent of it, and I think that a further suggestion might be that with this YOLO thing, with the weekly options, got a little bit out of control. So it would make sense for a regulatory framework to exist that the margin structure for pursuing large highly speculative trades would increase. And I don't know who controls it, but at certain times it seems to be way too excessive that you can bet on Tesla with such a small amount of money on Thursday and Fridays of every week, and the amount of speculation there is holding that thing up. And that's again a regulatory issue that should be changed. That the margin associated with buying options should be adjusted. I know there's many people in the room that are probably cringing because that would make investing or speculating more expensive, but it would justify real companies getting real valuations instead of the speculation here. So from my perspective, the regulatory framework is a lot to blame for what's going on here. But again, George, really appreciate the thought discovery that you had generated in these rooms.
Appreciate it much. Thanks, Stan. Good to talk to you. We haven't talked for a while. Charlie, you've been waiting. Charlie Munger fans, I love your Twitter handle. What's up, man?
Thanks, George. This is excellent what you do here for people, educating. Thank you. Just a question, given your decades of experience, what's the tipping point for the 10-year where you might see a sell? Obviously, you go back in cycles, 87, 74, 91, those eras, 2.5 to 3. I mean, if you listen to Soros, Druckenmiller, Tudor Jones, Paul Singer, Vanderbilt, all these experienced investors like yourself, Kerr Nelson, they've never seen such excess. And I think that you're a good example of Uber. And I just collectively look at the market cap, 250 billion. They've lost 30 billion. I mean, two other companies, Opendoor and Zillow, that reported they've collectively made 32 million in NPAT, and their market cap to get combined is 16 billion. I mean,
Charlie, I could listen to you all night. You the man. You got it. Okay. Someone needs to do a study. Of course, the brokers won't do it. The banks won't do it. But some guy will get a PhD. It's easy to do. Just go add up all the money that's been poured into these rat holes, and then take a look at what the actual cash flow, what winds up. I'm not talking about 1 year, 2 years. I'm talking about 5 and 10 years down the road, and just look at the productivity of capital. And people talk about productivity. They always talk about productivity of labor. But if you take an all-factor, a multi-factor productivity model, and you say what's the productivity of capital, and the billions and billions and billions just gets flushed down the toilet. It's complete rubbish. It's Wall Street foisting all this garbage on the public, and so no, I couldn't agree with you more. And so to answer your question, I think you asked, what point, what interest rate does the whole thing tip over? I don't know. I just think we're not. It's higher. It's higher. And by the way, it's not going to be the banks. Banks are in relatively okay shape. It's going to be someone like SoftBank that someone who's borrowed a lot of money. I'll give you one. Okay. Not that actually Tiger Global did borrow some money, but leave that aside for a second. A lot of the risk, it's off the bank balance sheets. It's in the pension funds of individuals. It's in endowments. Okay, it's in risk capital. But you're going to see coming soon to a theater near you, preview coming attractions. You're going to see the Tiger Globals of the world. And I don't mean to finger them, but people of that ilk just going out of business sale. I mean, Three Aces mentioned earlier, Carvana, the stock blew up. I mean, this idiot had 25% of his fund in one stock. Carvana's a zero. It's going out of business, all right? But you have things like Tiger Global, where they invest in so many of these cash flow negative things. These companies came public. Some of them came public too early. A lot of them are cash burn, and it's the fake it till you make it model. As long as you keep getting free money from the market, you can keep selling dollar bills for 80 cents and paper over the difference with free money from the capital markets. But if the free money disappears, that business model goes away. And so I think that's what's going to be happening. But to your question, what's the magic number where the whole thing blows up on rates? I don't know, but I just think it's higher from here. And again,
Thanks, George.
thank you. I think it's a good thing, not a bad thing. All right, three aces. Do we want to kind of end this room because we've been going at this for an awfully long time, my friend?
Yeah, no, I mean, I think tomorrow's another day. We may have some drama there, to talk about.
So this has been unbelievable. This has been, and I'll challenge anybody, this has been the best Twitter space ever in the history of Twitter. We have an unprecedented level of accumulation of intellectual capital. Some of the hardcore guys are still here. Jim Bianco's here. Dr. Alhaji is here. But what a lineup. What a lineup.
Hey, George, I hate to do it. We've had somebody that's one of our friends. He's been sitting there all night. He just has a really quick question for you. He said it's 2 seconds. Do you mind?
Go for it.
Go ahead, John. What do you got, brother?
Hey, thank you. Can you hear me?
We can.
Hey, it's not even really a question. You guys are all very smart, much smarter than myself. I'm a longtime investor, but we all have to remember we're only on this earth another probably 40, 50 years. Let's all take a breather, enjoy it. The ups, the downs. We have to remember that it's not all about today or next week or next month. Enjoy your time here. The markets are one thing, but enjoy your life.
Cool.
And
Thanks
let's have a good Friday tomorrow.
Thanks for ending that for us on a good note. Sorry, George. Go ahead.
Three aces. You can again if you want to close the room. I'm getting kind of tired here, so
yeah.
Why don't you close the room?
Wanted to say thank you to everybody who's donated in the past, everyone who's donated today. Don't want to beleaguer the point, but we just want to say thank you. We have that match out there for 50,000. We're 16,000 away. We're hoping to knock it out in the next couple, 2-3 meetings. So please don't take it the wrong way. It's all for a good purpose, and there's no self-centeredness to any of it. So sorry if it sounds a little like we're pushing that a little too much. My personal feeling is we're headed into a demargin situation and a forced liquidation, maybe a Ray Dalio, one of these guys. And, with any luck at all, we'll get rid of the frauds in the market like Tesla and ARK and some of these other ones, and get back to business and buying good quality stocks at good prices. That's all I have. Thank you very much, everybody. Dr. Bobby J, Abe, Jim, my new hero, all of you rock stars that have come here tonight. You're just absolutely just fabulous. Thank you very much. And thank you, George.
Thanks, you three aces, and good night, everyone. We'll do this again before too long. Everyone, take care. Good night. Be good. Be well. Be